Hi all, good evening. Am I audible?
Yes, ma'am.
Yes. Okay. I hope you are ready for today's marathon session. Yesterday we completed as much as possible from financial reporting. We completed the concepts of regulatory framework and conceptual framework. We covered almost 95% of the standards and we have three standards remaining, which we will be revising today. Then we will move on to our question practice. We'll do a question from consolidation and if possible from interpretation. And cash flow statement, I'm not sure because cash flow statement preparation will not be coming for your exam, isn't it? So we'll see what all we can do with this limited time. Anyway, I'm sure that this will be an effective session for you. And myself, Navami, I'm here to teach you how to make use of this limited time, 17 days for your exam. Okay, so I have a plan for you. Yesterday, you guys had requested me to give a plan for this short period. What can you do? How can you crack your June session financial reporting exam? So I have a small plan which I believe will help you to score high marks. Okay, don't panic. I know there is limited time, but still you can crack it. Okay, 17 days is not more than you actually think. Okay, so let me share my plan with you. Hope you can see the screen. Can you see my Excel? Is it visible?
Yes, ma'am.
Yes. Just give me 1 second. So yesterday, some of you asked me to give a small plan for this 17 days, starting from tomorrow. Tomorrow is 19th May, and your deadline, your final exam date is June 5th. Okay. So for this short period, what you can do is, I hope you are already, like what, you have already completed your portions. And even if you have not completed your portions, I have short notes for all standards. You can go through those short notes. Don't go in depth in these few days. Okay, if you are going in depth, you will find more and more. Financial reporting is something that does not have an end. Okay, you cannot find an end for all these standards, rules, principles, and all. So what you can do is make use of the short notes. I'll share the short note in the group today. Okay, already my students have those notes, I believe. So make use of those short notes. And for the first 4 days, starting from tomorrow till 22nd May, you revise all standards. Okay, revise all standards and revision includes question practice as well. Okay, so along with revising the standards, you have to solve section A and B questions from Kaplan. Those are just 2 mark questions. Usually you have options. It will be multiple choice questions or it can be objective type questions. So whatever it is, you have to go through Kaplan section A and section B. I can share you the question numbers from which all topics from IAS 16, these are the question numbers. From IAS 20, these are the question numbers. So I can share you a plan for that also. In the group, I'll be sharing it today. So from 19th May to 22nd May, you have to dedicate your timing for your revision of standards, IAS and IFRS standards. Revision includes section A and B question practice also. Okay, 4 days plan. Then 23rd to 25, 3 days, 23, 24, and 25. These 3 days, you will be practicing essay questions, section C questions from Kaplan, focusing on single entity statement preparation, preparing single entity SOFP and single entity SOPL. From Kaplan, you can use this. Group link. So, Atul, where did you get the link of this class from? How did you join the session today? So again, I'm telling you, anybody who's not there in the group, you can contact me personally so that I can share you the resources. What all resources that are needed, you can ask me, I'll be sharing it. Okay, so this is my number. If you need any material, you can ask me. Then, so we were discussing about the plan. For the first 4 days, go for standard revision and revise section A and B questions. Then, the next 3 days, whatever you have revised based on the standards, uh, incorporating those knowledge, you will be forming, you will be preparing the essay question. Okay, you'll be preparing the statement. So, this single entity financial statement preparation will be your focus for the next 3 days, 23rd, 24th, and 25th. You will be preparing single entity statements, SOPL and SOFP, from Kaplan section C. They have the division itself. In single entity statement preparation, there's a subheading in your Kaplan textbook itself. So go through those questions. Practice as much questions as you can in these 3 days. And make sure that whatever you are practicing, you understand the concept. That is important. It's not how many questions you did. It's based on how well you did it. Okay, how well you understood that question. Okay, then the next 2 days, 26th and 27th, you dedicate for consolidation revision, conceptual revision for consolidation. Consolidation involves consolidated SOPL, SOFP, group disposal, and associates. So all these portions, you need to be aware of the rules and principles. And along with this revision, you can do section A and B question practice. Then the next 2 days, 28th and 29th, we will be doing FS preparation for consolidation. Okay, consolidated statement, consolidated SOPL, SOFP, all those you will be preparing in the next 2 days, that is 28th and 29th. Then 30th May is completely dedicated for interpretation, how to analyze and interpret the statements. There's not much to learn. Okay, topic wise, you have only one chapter, so one day is more than enough. So within this one day, understand what are the ratios, learn the equations. So why I'm keeping this for last is if you are learning these ratios, learning these equations on 19th or 20th, there are chances that you will forget it before your exam. So keep it for 30th, that is for the last week. You learn this interpretation. Make sure that you by heart all ratios. I have the formula sheet. I've shared it in the group, and today I'll be sharing that formula sheet again, which includes all the formulas, all the ratio equations. Then practice Kaplan C questions, section C questions. Why am I not focusing on section A and B? This is a short term. You need to make use of the time wisely. There's 2 more questions from interpretation is what calculate gross profit margin, calculate net profit margin. If you are practicing section C questions, that incorporates the calculation of all these things, GP margin, NP margin, ROCE and all. So there is no, it's not necessary that you practice the interpretation 2 more questions. From interpretation, you can go for section C question directly. That is for one day, one whole day you are dedicating for analysis and interpretation. Then 31st May, the rest of the topics, remaining topics that you have skipped or you have confusion, you can go through it. That is conceptual and regulatory framework and an overall revision. Whatever is going through your head, you are not confident about IAS 10. In that case, go and revise IAS 10. So likewise, 31st May is for you to make an overall revision to boost your confidence. Okay, that is a one-day revision. And the next 2 days, you have to go for mock exams. You have to do at least 2 mock exams. Okay, you have to set timing 3 hours. 3 hours is your exam time. So I'll teach you today how to make use of this ACCA exam platform. So you have to log into your My ACCA account and use ACCA platform to practice. Okay, that is to do this mock exams. There will be question papers available in the mock in your My ACCA account. There will be specimen exam questions. So you have to do this exam yourself by keeping the timing. Make sure that you keep the timing. Okay, so anytime you can log in, maybe from 4 o'clock to 7 o'clock. Okay, as per your time. Okay, dedicate 3 hours for a mock exam. On 1st June and on 2nd June, you have to do at least 2 mock exams. If possible, you can do more. And the next 2 days, that is 3rd and 4th May, is for you to relax. Okay, you don't have to panic. I'm sure that, I mean, not sure, but A 90% possibility is that you may not have like what a very much confident. You will not be very much confident, or you will have remaining topics to cover. But still, you need to find time for relaxation. Relaxation is very important. If you panic or if you are tense, it will affect your exam. Whatever topics you have covered, that will also be like running throughout your head. Okay, so relaxation is important. These 2 days, 3rd and 4th May, 2 days before your exam, you can relax and you will have to attend your exam as whether it is remote or center based exam. On June 5th, you will be facing that day. Okay, the day that we all are waiting for. Do we have any mock exams that? Yes, of course, you have lots of mock exams. I'll show you how to, like what? How to use this mock exam. Okay, how to approach the mock exam, where to get the question paper and all, I'll teach you. Is this your first exam, Saki? First skill level paper? So, you haven't done any mock exams for your previous papers? Direct theory question, Dipankshi, it can be from anywhere. Maybe from consolidation also, they will be asking you the control criteria. Maybe from IFRS 15, they can ask you the conditions. Okay, from all standards, FR is a subject which has theoretical importance also. Yesterday, I told you there is 60 percentage problem and 40 percentage theory. Okay, theory is also important, then only you can pass. Uh, no, I don't have extracts. If you want, I can share extracts, but it's like it's better for you to practice in the ACCA practice platform. There are like what 6 or 7 past question papers available. The essay questions you can practice there itself. You have specimen exam, you have practice exam, you have June specific mock exam. So all those mock exams are available in your ACCA platform itself. Okay, so extract, if you want, I can extract and give, but I think there's no point in extracting because you already have the past question papers and mock exams available in your ACCA platform. What standards are we going to cover today? Today we are covering IFRS 15, IFRS 16, and IAS 33, and it's conceptual revision. Just as I told you yesterday, what I can do is I can give you a recorded session for individual single entity statement practice. Because if you are dedicating this 2 day marathon session completely for standards, then it will be like our topics may not be covered. So we are discussing each and every standard, and I'll show you how to prepare the single entity statement. But we are not preparing a single entity statement. Okay, if there is time, then we'll go for it. Otherwise, we will be, I think the time allocation will be for sufficient for consolidated statement preparation and consolidation conceptual revision. Then we have to do the conceptual revision for interpretation, and we will do an essay question for interpretation also. That's our plan for today. If you have time, if we have time, then I can go for an interpretation, sorry, single entity statement preparation as well. Otherwise, I can provide you the recordings of preparing single entity statements. Okay. Yes. Doing mock exam from ACCA platform itself is the most wise decision because there are certain features in ACCA platform that, I mean, some features of this Excel, the Excel that we normally use, that has removed from your ACCA platform. So you better practice it in your ACCA platform itself. I don't know how to do section C ratio questions. I know all ratios, but I don't know how to analyze them, right? I'll do it today. Shivangi, I'll help you with this today and I'll show you how to frame your answer. Okay, we'll take a sample question and I'll teach you how to solve an essay question for interpretation. From where we get March attempt previous question paper. I'll show you. Yashika, all these questions, I have answers for all these questions, and that's in my ACCA platform. So my plan for today is, we couldn't complete three standards yesterday. Initially, I'll be covering these three standards, and after that, just after that, before going to the question practice, I'll open my ACCA account, as I'm also an ACCA student or ACCA member, whatever. So I will be showing you my ACCA account and how to reach these mock exam platforms, how to access past question papers, all those things I'll show you. And I'm not sure, Yashika, if the March question paper is available. I think it's not yet available in the platform. I haven't gone through it. Let's see if it's there. Whatever is disclosed by the ACCA board, it will be there in the ACCA platform. Okay, if you are lucky, you can find March attempt question paper also. It's not like they are providing the question paper, they will only give you the section C questions. Okay, they will not be giving you the entire question paper. They will only provide you two essay questions, 20-mark questions, and that will be selected by themselves. Okay, so let's see whatever is available in the my ACCA platform. And yesterday, somebody also asked me to give the weightage. And this is the weightage that I could get from the plan, like from top to bottom. The first priority is for IAS 16 and IAS 12 and IAS IFRS 9. These are the three important standards that I've already told you yesterday. These are very frequently tested. For the 6 times and 4 times and all, you can ignore it. But this is just a weightage for you. Make sure that the initial standards, so you go in this order, you can learn in this order. First priority is for IAS 16 because this is a base standard, property, plant and equipment. It is a connective standard. Then IAS 12, income tax. Income tax is very frequently tested. You can expect it in all exams, all attempts. Then IFRS 9, financial instruments. This is also very frequently tested. Almost in all sessions, you can get a question from IFRS 9. IAS 32, IFRS 7, and IFRS 9. These are all related with financial instruments. Then IAS 36, impairment loss. Then IAS 37, provisions. IAS 40, investment property. Then these are all like what? Medium range. You can expect questions from these for maybe 2 marks or 4 marks or maybe not. And the final standards are IAS 10, IFRS 3, IAS 7, and IAS 20. These standards are very rarely tested, and IAS 7 is based on cash flows. Okay, it's only like once in 3 sessions it will be coming, cash flow statement. So, but in the previous 6 sessions, you cannot find anything based on cash flow statement. From the recent Kaplan kit, I took this information. Okay, based on their analysis, this is the weightage order. Got it? Somebody requested me yesterday. That's why I have this information here. And I'll be sharing this document with you today itself in the group. Okay, but it's not for you to skip something. Even if IAS 20 and IAS 7 is not tested, you have to go through it. You have to understand the concept. It's not like you cannot expect a question this session. Okay, what if they feel like giving us a question from IAS 20 in this section? So you cannot skip anything in FR. Everything is important. But if you need a weightage, then this will be the order. Got it? And don't forget about our plan. No rush. You have to follow this plan if you want. It's not like I'm imposing this on you. If you want, this is a plan that I have created for you. You can follow this plan and very smoothly you can score high marks for this June exam. Okay. Any other doubts regarding exam? If there is no doubt, we can go for these standards because we have very less time. Can we move to the conceptual revision? Yes, Debri. Okay. So we revised almost all standards. Yes. Our next topic is IFRS 15 revenue from contract with customers. Okay. IFRS 15 revenue from contract with customer is concerned with the recognition of revenue arising from fairly common transactions of sale of goods and rendering of services. So a company, it can generate income in several manners. Okay, maybe if you have a computer, it's for you to work in the office. So if you are selling this non-current asset, if you are selling this computer, you'll get earnings, you'll get income. But this income is not part of revenue. The term meaning of revenue, the item revenue includes only the income generated from sale of goods and rendering of services. Whatever is the operational activity of the company, the core activity of the company, from this operations, whatever is the income generated, that is known as revenue. And revenue is the first item of SOPL. In your statement of profit and loss, you will be starting your SOPL with this figure, revenue. Okay, so this chapter is very important. When can you recognize a revenue? The date of recognition is important. And what is the amount of revenue that you have to show in your SOPL? Okay, so understand that revenue is the income generated from sale of goods or rendering of services. For revenue recognition, you have a 5-step approach laid down by IASB. The first step is identifying contract. Okay, ensure that there is an actual contract existing. So for a contract to exist, there are 5 conditions. Okay, the first condition is it must be approved by both parties. Okay, the terms and conditions of the contract, it must be approved by both parties, and the terms must be identified. The payment terms must be identified. So, in what mode? If you are planning to give the consideration in the form of check or cash or online transfer, whatever, the payment terms must be identified. There must be commercial substance. Commercial substance means it must not be this contract, it must not be influenced by somebody. It's like you have to have the same price, contract price for any other person in the market. If you are providing, if you are engaging in a contract or an agreement with your friend, it will not be having a commercial substance. So to have commercial substance, every person in the market will get the same item for the same cost. Okay, the contract price will be same for every market participant. Then only we can say that this contract has a commercial substance. Then it is probable that the entity will collect the consideration. So if party A is providing goods and party B is giving the consideration, then party A need to assure that party B is capable of giving the consideration. Okay, they must have a background check and make sure that they have the capability, our customer have the capability of giving the consideration. That is probability of collecting consideration. And the entity can identify each party's rights. So both parties' rights must be laid down in the contract itself. What is the rights of party A? What are the rights of party B? That must be laid down in the contract. So if all these 5 conditions are met, then you can say that there is a actual contract. There is an actual contract existing. That is your first step, identification of contract. So Deepakshi, this is your answer. You can get a theory question from this part. Okay, they may be asking you to test. They will be giving you a scenario, and you will be required to test whether there is a contract existing or not. Okay, and everybody please mute. Yes. Okay. So this is your first step in the 5-step approach for revenue recognition. Your second step is identification of separate performance obligations. In your contract, there will be more than one or more than 2 performance obligations. Okay, it's up to you. As per a contract, you are providing a hardware. Okay, let's say, for example, you have a computer hardware. Along with this hardware, you are selling the software also. you are selling the technical support, okay, and you are also having installation. So all these things, since we can buy it separately from the market, since they are separately available, since they have distinct existence, we can say that these are all separate performance obligation. So each and every promise that we provide, they are known as performance obligations. So all these performance obligations, if they are distinct, they will be sorted out, they will be identified. So identifying separate performance obligation is your second step. In the third step, you will be determining the transaction price. What is the overall price for this contract? Okay, you have four obligations in this contract. So for all these contracts all together, what is the value that you are fixing? What is the price that you are fixing? Okay, that is your transaction price, and that's your third step. And when you are fixing your transaction price, you have three important factors to consider. First one is variable consideration, which means the most probable amount must be recorded as transaction price. So this transaction price is the value that you usually take to SOPL, the price that you are expecting to receive from this contract. Okay, this is the SOPL value. Transaction price means the price that you expect to receive based on this contract. Now, what is variable consideration? It is the most probable amount that should be recorded. So, variable consideration is a situation where sometimes you will be providing option for returning. Okay, you are the seller, you sold some goods to your customer, and you gave them an option to return. And you are expecting that 10% of your total sales will be coming back. Okay, the people will be bringing back your product based on some issues, okay, some damages or whatever. So you are expecting a return of 10%. In that case, the 90% of the actual amount will only be recorded. For example, your sales price is 1,000 and you are expecting 10% returns. So after deducting the return, whatever is the expectation, okay, whatever you are expecting to receive as the ultimate final amount, final money that you are expecting to receive from the sales, that only will be taken as transaction price. Okay, so this transaction price is also called contract price or contract revenue. So this contract price will be considering after considering the variable consideration. Usually, transaction price is the price of the contract. Okay, you have 1 million. The price of this contract is 1 million, but you are expecting that they will be returning the products. 10% of the products will be returned. In that case, only 90% of this 1 million can be recorded as transaction price. Then, next one is non-cash consideration. Sometimes, as per the contract, they will be agreeing for non-cash consideration. For example, an exchange. You are exchanging an asset. Okay, your company is providing goods, and in return for this inventory, the other company is giving you their goods. Okay, their assets. So in that case, the transaction price will be the fair value of items given as consideration. So whatever we received as consideration, okay, we got some items from the other person. From party B, party A received consideration in the form of assets. Okay. So whatever is the asset, whatever is the item that you have received, you need to check the fair value of this asset or this item. And this fair value will be considered as your transaction price. Then you have to see if there is a financing component. Sometimes your consideration will be deferred. Okay, on a future date, they will be giving you the payment. For example, A company sold goods to B company, but B company will be giving the proceeds, okay, not proceeds, they will be giving the consideration only after 1 year or maybe after 2 years. So here, whenever there is a deferred payment or receipt, in that case, you need to calculate present value. So whenever there is a financing component, that is, if there is a future transaction value, on a future date, you will be receiving the payment. If that is the case, you need to calculate the present value of this future payment. Okay. We already discussed the formula yesterday. Present value equal to future value into discount factor. Discount factor is 1 by 1 plus R raised to N. Okay, so you need to apply this equation and calculate the transaction price. Okay, so this is step number 3. So theoretically, IFRS 15 is of some importance. Okay, step number 4 is allocation of transaction price. In step 3, whatever is the transaction price that you have fixed, this transaction price will be allocated to each performance obligation. In step 2, you identified 4 performance obligations, for example. And in step 3, you identified the transaction price. You determined the transaction price as 1 million. So now this 1 million will be allocated among all 4 performance obligation based on their standalone selling price. Okay, what is standalone selling price? The standalone selling price is the market value of this item when you are selling it separately. If you are selling the hardware separately, at what value you will be providing this computer hardware? Then, if you are selling this warranty separately, what is the separate value of the warranty? Okay, so the standalone selling price is a separate value of each product. Based on the standalone selling price, you will be allocating the transaction price to each performance obligation on a pro rata basis. Okay, the allocation is on a pro rata basis based on the standalone selling price. And your last step is revenue recognition. This is the 5th and the final step, recognizing revenue. To recognize revenue, you need to see whether the revenue is recognized at the point of time or over a period of time. If revenue is recognized at a point of time, in that case, the whole transaction price can be recognized as revenue immediately. But if revenue is recognized over a period of time, in that case, you need to calculate the percentage of completion, the percentage of progress, and based on this progress percentage, you will be determining the amount of revenue to be shown in SOPL. Okay, so in the 5th step, your objective is to identify whether this transaction is happening at a point of time or is this revenue recognition over a period of time. Based on this, you will be deciding how to record the value in SOPL, how to record the transaction price. So if it's at a point of time, if you have established that this is a point of time sales, then the transaction price itself will be your revenue for the year. Whatever is your transaction price, that you have determined in step number 3 by taking into consideration the variable consideration, then financing components, non-cash consideration. After considering all these factors, you will be determining your transaction price, isn't it? So whatever is the transaction price, that itself will be the revenue recognized if your transaction, if your sale is established at a point of time. Okay. Then, if it's over a period of time, you need to consider the progress percentage or the percentage of completion till date. Progress percentage. We will see how to calculate the progress percentage and all. Okay. So briefly, this is how IFRS 15 is treated. There is a 5-step approach laid down by IASB. Step number 1, identification of contract. Step number 2, identifying separate performance obligation from the contract. Step number 3, determining transaction price of the overall contract. Step 4, allocating the transaction price to all performance obligations. And the last step is revenue recognition. This revenue recognition can be at a point of time or over a period of time. Okay. I hope you got the idea of IFRS 15. Then, when an entity satisfies the performance obligation over a period of time, that is important, over time. So if performance obligation is over a period of time, how can you identify what are the situations of performance obligation satisfied over a period of time? The customer simultaneously receives and consumes the benefit provided by the entity's performance as the entity performs. So when you are performing this, at this At that time itself, simultaneously, the consumer or the customer is getting the benefit. So this is denoting service. So if your company is a service providing company, then whatever service you provide, based on this service, you will, based on the percentage of completion, you will be calculating this, what? Revenue to be recognized. For example, if you are providing this technical support service, okay, or you are providing warranty service, this warranty will be for 1 year or maybe it's for 2 year warranty. So in that case, you will be allocating this revenue throughout the 2 year period. If your warranty service is for 2 years, then this service will be provided for, will be allocated for 2 years. Okay, in the 2 year statements, you will be splitting this service, the revenue from this service. That is a example for revenue recognition over a period of time. Then the entity's performance creates or enhances an asset that the customer controls as the asset is created or enhanced. Now, this is the most common example for revenue recognition over a period of time. That is construction contracts. Construction contracts. If your company is a construction company and you are engaged in a contract to build a bridge or to construct a building, in that case, this is something that takes time. Yesterday we discussed what is qualifying asset. Qualifying asset is any asset that takes substantial period of time to get ready for its intended use or sale. So if you are engaging in the construction of these qualifying assets, in that case, you have to recognize the revenue over a period of time based on the progress percentage. Then, entity's performance doesn't create an asset with an alternative use to the entity, and the entity has enforceable rights to payment of performance completed till date. So, this example, this is denoting to customizable products, customized assets. So as per the instructions of your customer, you are producing an asset. Okay. So this asset is of no use to another buyer. Okay. In the market, we have produced this based on the instructions of customer A. Now customer B does not need this asset. Okay. For customer B, this is of no use. So in that case, if I am producing such an asset, then in that case, this is also coming under the revenue recognition over a period of time. So these are the examples of recognizing revenue over time. Keep in your mind service, construction contract, and customize the assets. Then, if performance obligation is satisfied over a period of time, then in that case, revenue is recognized as per the stage of completion or percentage of completion. This percentage of completion can be calculated using two methods, that is output method and input method. Using either of these two methods, you will be calculating the percentage of completion or the progress percentage. So let's discuss what is input method and what is output method later in this chapter itself. Before that, you need to understand whenever you have decided to recognize revenue over a period of time, that is, you have identified this is a service or this is a construction contract. In that case, let's take for example, this is a construction contract for 1 year. Okay, a 1 year construction contract. In that case, you need to check whether the expected outcome is profit, loss, or if it's unknown. You don't know whether it leads to a future profit or loss. So when I'm telling that to analyze, to find the expected outcome, this expectation is after some period. See, this is a timeline from 1st January to 31st December. This is the construction period. Just an example. From 1st Jan to 31st December. During this period, you are having your construction. So over this 1 year period, you will be recognizing revenue. Or let's say to make it more clear, we can say the year end of the company is here. Year end is 31st March. From 1st April to 31st March is your year end. This is not here, sorry. Here it will be 31st March. So your accounting year starts from 1st April and ends in 31st March. This is year end. Now, as you can see, this 1st January to 31st December, this is a construction period, and the construction is happening for 2 accounting years. Okay, when you are preparing statements, you will be having revenue for 31st March 2001. For example, for 31st March 2001, you can recognize revenue till this date. Then the remaining from 1st April 2001 till 31st March 2002, you will have another set of revenue to recognize. So this revenue will be split between the accounting period. Okay. In that case, here what I'm telling is throughout this accounting period, throughout this construction period, that is from 1st January to 31st December, moving forward, you will have to analyze the final figure, final outcome, whether it is an expected profit, loss, or whether it is unknown. Here, when you're entering into the contract on 1st January, on this date, obviously, we will be entering into a contract. We'll be signing a contract only with an. Otherwise, you won't be signing a contract. You are party A, whether you are the seller or whether you are the buyer, you will be signing a contract only with an expectation that you will receive profit. So initially, obviously, your expectation will be profit. But moving forward, let's say now it's March, our accounting year end. As on this date, you need to predict whether in the future, after construction, on this date, on December, if you will get a profit from this contract or if you are expecting a loss on this date. Okay, so we are making an expectation in the middle of the construction period. Construction is from 1st January to 31st December, and in the middle of this construction period, you are assuming that you will have a profit. Okay, in that case, what are we supposed to record in the statement? Okay, understand the timeline. Your first situation is they are not asking you the expectation as on 1st January. 1st January, you will be expecting a profit after at the end of the contract. You will be definitely expecting a profit. But moving forward, after 2 months of construction, that is after January, February, and March, after 3 months of construction, now what do you expect? You might have incurred lots of costs. Okay, now based on this, whatever happened in these 3 months, what is your expectation? Is there a change in your expectation? Okay, that is what we are checking. So if your expectation is still profit, if you are still expecting profit, in that case, you will have to record the revenue. Revenue should be recognized according to the progress of the contract. You only have to recognize the revenue. You have to do nothing. If you are expecting a profit, initially on 1st January, when you started the contract, when you entered into the contract, your expectation was profit. And now also, after 3 months also, your expectation is the same. You are expecting a profit itself. In that case, you have to record the revenue only. You don't have to record anything. Only revenue is to be recorded in SOPL based on the progress percentage. Then, as on 31st March, if your expectation is loss, if you are expecting that from this contract, if it goes like this, you will be having a loss. Your cost will be greater than your expected revenue, your transaction price. If that is your expectation, you have to do two things. First one is you have to recognize the revenue in accordance with the progress percentage. Revenue is to be recognized anyway if you are expecting profit or loss. Okay, but if you are expecting a loss, in that case, the whole loss should be recognized immediately by recording a provision as an onerous contract. So my point here is, whenever you are expecting a loss from a contract, that contract is known as onerous contract. Okay, we have heard this term. Yesterday also, I've discussed this term. I told that I'll be discussing it in IFRS 15. Onerous contract is a contract from which you are expecting a loss. Okay, you will be entering into the contract by expecting a profit, but later on, moving forward, you are expecting a loss from this contract. In that case, now this contract will be named as onerous contract. Whenever there is an onerous contract, you need to create onerous provision. How to create a provision? As per IAS 37, we discussed the journal entry for provision yesterday. Anybody remember? Journal entry for recording provision. What goes to debit and what goes to credit? Anybody? Debit. Yes, very good, Aradhana. Debit expense and credit provision. Yes, good. Debit expense in SOPL and credit provision liability in SOFP. So what happens here? If you are expecting a loss, in that case, you will be recording a revenue in your statements. Okay. You will be recording an expense in your SOPL and you will be recording a liability in your SOFP. If you are expecting profit, then things are easy. You only have to record a revenue, nothing else. But if you are expecting a loss, in that case, you have to record a revenue, you have to record an expense, and you will be recording a liability. Okay, so you are combining the knowledge of IAS 37 here. IAS 37, provision, contingent asset, and contingent liability. When to create a provision? Whenever you are expecting a loss based on a contract, that is known as onerous contract. And based on onerous contract, you will be recording an onerous provision. To record a provision, you have a journal entry, debit expense, credit liability. So, in short, whenever you are expecting loss from a contract, you will recognize revenue based on the progress percentage. You will recognize an expense based on the expected loss, and you will recognize the same amount of a liability in SOFP based on the expected loss. Okay, so these are the three things that you have to do when you are expecting loss from a contract. Then, the last case is if the expected outcome or progress is unknown. You don't know the progress. You cannot analyze. It's just 3 months. Now you are just confused. You don't know in the future if you'll get a profit or loss. So in this confused state, what can you do? A revenue should be recognized in the up to the level of recoverable cost. So for these 3 months, whatever is the cost that has actually incurred, see if you are expecting to recover these costs. If you incurred 10,000 and if you are expecting to recover this 10,000 from this contract, okay, in that case, whatever is the actual cost spent till date, that itself will be recognized as revenue in the statement. What is the situation? You are expecting, sorry, you don't know the expectation, whether it will be a profit or loss. You are confused. In that stage, you will be recognizing revenue in your SOPL, but this revenue figure will be the actual cost incurred till date. Then, the contract cost should be recognized as an expense in the period in which they are incurred. And this contract cost should also be recognized as expense. So, you'll be recording an expense and you'll be recording a revenue. These are the three important situations that you need to be aware of. Your treatment, your revenue recognition will be based on your expectation. If you are expecting a profit from the contract, then you'll be recognizing revenue only. If based on the progress percentage. If your expectation is loss, then you will be recording a revenue based on progress percentage, and expense will be recorded based on the expected loss provision. Then a liability provision will be created based on the expected loss. And if you are in a confused state, if you don't know that whether it is an expected profit or loss, in that case, whatever is the actual cost incurred till date, that cost itself will be considered as revenue with an assumption that you can recover all these costs. Okay. And a contract cost should also be recognized as an expense in SOPL. So these are the treatments in 3 different situations. if your expectation is profit, loss, and if it's unknown. I hope it's clear. Now, what is the value based on this revenue recognition to be recorded in SOFP or in SOPL? You can currently ignore this heading. It is of now. It is not of much relevance. Okay, just ignore this heading. We will see through 4 steps. We will see what will be the value. What is the actual value to be transferred to SOPL and what is the value to be transferred to SOFP. All those things we can discuss. First step is calculating the overall profit or loss. And what is the objective of this, doing this? Just to check whether there is expected loss or expected profit or whether the situation is unknown. Okay, whether it is a no profit, no loss situation. So, for determining whether there is a profit or loss, for that purpose only you are doing this. The total contract price divide minus total contract cost. Cost is what is incurred as expense and price is what you receive as income. So, contract price minus contract cost is equal to expected profit or loss. If it's positive, then it's an expected profit. If it's negative, then it's an expected loss. So here the cost till date minus cost to complete, expected cost to complete and expected cost till date. These two can be added together to get the total contract cost. Total contract cost. So whatever is the contract cost, you will be deducting it from the contract price. Then the net figure will be expected profit or loss. So if it's profit, then you only have to record revenue. If it's loss, then you will be recording revenue and provision. In your second step, you will be determining the progress of the contract. How to determine the percentage of progress? Using input method. It is based on the inputs used. A commonly used measure looks at contract cost incurred to date and percentage of total expected cost. So as per input method, you are calculating the progress based on contract cost. Okay, based on cost. Input method is based on cost. So as per input method, percentage of completion is equal to cost incurred till date divided by cost of completion. Or total contract cost, not cost of completion. The better term is total contract cost. Okay, this is your equation for calculating a percentage of completion as per input method. Then, as per output method, it is based on the performance completed till date. This is commonly done based on the value of the work certified till date as a percentage of a total contract price. So as per output method, the percentage is calculated based on the price. Okay, input method, it is based on cost and output method is based on price. Based on the contract price, we will see work certified till date. It will be given in the question. Work certified till date divided by total contract price, not cost. Contract price. Okay, so input method is based on cost and output method is based on price. Then, based on either of these two methods, you will be calculating the progress percentage. Where the progress cannot be measured, revenue should be recognized as the cost incurred till date. Whatever is the cost incurred till date, that itself will be recognized as revenue if the progress cannot be measured. That is, if your expectation is uncertain. Okay, so using either of these two methods, you'll be calculating the progress percentage. Now, the next step is using this progress percentage, you will calculate a revenue recognized till date. Revenue recognized till date. How to get the revenue recognized till date? Total price into progress percentage. Progress percentage that we have calculated using input or output method multiplied by total contract price. That is your revenue recognized till date. From this revenue recognized till date, if you have already recorded a revenue in the previous year based on this contract, that will be removed. And this figure, whatever is the net figure that you get after deducting the revenue recognized till date and the revenue recorded based on this contract in the previous statement, that will be current year's revenue. In the current year's SOPL, you will be recording this as revenue. Then likewise, cost of sales, the total cost till date. So whatever is the cost incurred till date, from that you will be deducting the cost that you have already recorded. Okay, cost till date minus the cost that is already recorded in the previous year's SOPL. The net figure will be your current year's expense. Current SOPL as expense. This will be your revenue. Okay. Then the net figure, current SOPL revenue minus expense, that will be the profit based on this contract, current year's profit. Okay, current year's profit from this contract, specifically from this contract. So this is a very important statement. The values to be taken to statement of profit or loss. Okay, that's it. Now we have one more thing to discuss in IFRS 15, that is regarding the values to be taken to statement of financial position. At the year end, there will be either a contract asset or liability. You need to understand what is contract asset and contract liability. This is similar to receivable. Contract asset is similar to the receivable, money that is not yet received. And contract liability is like trade payable. You are supposed to make payments. Okay, it's somewhat similar, but it's not exactly having the same meaning. Then, how is this contract asset or liability calculated? You have a small equation. Revenue recognized till date, that is in the previous statement, what is the first figure? Revenue recognized till date is total contract price into progress percentage. That will be your revenue recognized till date. So from this revenue recognized till date, you will be deducting the amount invoiced or billed. Will be given like amount invoiced or billed to the customer. So if you deduct this amount invoiced or billed from the revenue recognized till date, you will be getting your remaining contract asset or liability. If it's a positive figure, then there is a contract asset. You have some receivable from the from your customer. Okay. Otherwise, if it's a negative figure, then it represents a contract liability. This contract asset and liability are current accounts. Contract asset is a current asset and contract liability is a current liability. These assets and liabilities will be shown in statement of financial position. Got it? So that's all about IFRS 15. It's not like all about IFRS 15. You still have a few more things to discuss in depth. If you are going in depth, you have so many things to discuss about IFRS 15. But briefly, if you are summarizing IFRS 15, these are the things that you need to keep in mind. There is a 5-step approach. And as per the 5-step approach, you will be calculating revenue recognized. Revenue recognition can be at a point of time or over a period of time. And if it's at a point of time, always keep in mind the key term. If it's at a point of time, in that case, you have to see the date of establishing control, the date on which ownership is transferred. That is the date on which you have to record your revenue. Date on which control is transferred. That is the keyword. Got it? This is at a point of time. Now, whatever we discussed using this four-step approach and all, that is revenue recognition over a period of time. If it's at a point of time, only see whether the date of transfer of control, and on that date, the entire transaction cost will be recorded as revenue in your statement. If it's revenue recognition over a period of time, then throughout the period only, you will be recording revenue based on the progress percentage. That's about IFRS 15. Next is IFRS 16, leases. Lease is also a contract. It is very much similar to IFRS 9. Lease is a contract. Just 1 second. Yes. And based on this contract, for one party, you will get the right to use of an asset, and for other party, you will get the consideration. Okay. So there are two parties. The one who is providing an asset, okay, the one who is leasing the asset, that is the lessor, and one who receives the right to use of asset is the lessee. Okay, so the relationship between lessee and lessor is like lessor is the provider and lessee is the receiver. What is lessee receiving? Lessee receives right to use. Receives right to use the asset. Okay, lessee is not having control over the asset. Control is still in the hands of lessor or the provider, but lessee can use the asset. Then, what is lessor receiving? Lessor receives consideration, receives money or some mode of consideration. Okay, the lessor is receiving consideration and lessee is receiving right to use of the asset. We in financial reporting, we only have to study about lessee point of view. Always assume that we are the receiver. Okay, we are leasing the assets. Okay, from the lessor point of view, you will be learning in the advanced paper SBR, not in FR. Okay, so lease is a contract where there are two parties, lessor and lessee. Lessor receives the consideration and lessee receives right to use the asset, not control. They does not get the control over the asset, only right to use. Now, based on this, let's see what is the treatment for lessee. We only need to study lessee accounting. Lessor accounting is not in FR syllabus. Lessee should account both right of use asset and lease liability. So lessee is supposed to record two things, right to use asset and lease liability. So the basic journal entry, this is very important. The basic journal entry of lease accounting, lessee accounting is debit rights to use asset and credit lease liability. This lease liability is a non-current liability and right to use asset is a non-current asset. Okay, so based on a lease contract, the lessee will be recording two things in the statement, right to use asset and lease liability. Then, what is a lease liability? Initial value of lease liability, the amount to be shown in this journal entry. Initially, the value of lease liability is calculated as follows. It is the present value of lease payments. Initial value of lease liability equal to present value of lease payments. And lease payment includes all these four things. Fixed annual payments, the amount expected to be payable under residual value guarantee. Then option to purchase, the amount of option to purchase only if it is reasonably certain. If it's reasonably certain that the option given by the lessor will be taken by lessee. Option to purchase or option to extend. So this option will have an extra charge that will be part of lease payment. Then termination penalties. If lessee is terminating this contract, breaching this contract, in that case there will be penalty. So all these figures as part of lease payments, and you will be adding the present value of all these lease payments, and this present value total is the lease liabilities initial value. Okay, initial value of lease liability equal to present value of lease payments, and lease payment includes all these four items. Then, right of use asset. This is the other party in your journal entry. You got the initial value of lease liability. Now, what is the initial value of right of use asset? This is a simple format. Yes, 1 second. Any doubts? Okay. Is it done? Yes. Okay. So here we are discussing about right of use asset, initial value of right of use asset. Initial value of right of use asset equal to opening balance of lease liability. That is the initial value of lease liability that we have calculated. That is present value of lease payments plus lease payments made on or before commencement date. If it's an advance payment, then the advance amount that is already paid, that will also be included as part of right of use asset. Then initial direct cost, present value of dismantling cost or decommissioning cost. Then any incentives received must be deducted based on this contract. If the lessee is receiving any incentive, that incentive must be deducted. So after making all these adjustments, the net figure will be right of use asset. But it is not always necessary that all these items will be coming for a contract, in a contract. If there is an initial direct cost, if there is dismantling cost, then only you have to make the adjustments. Otherwise, the lease liability amount, initial value of lease liability itself will be the initial value of right of use asset. Now let me ask you one thing. I told you that for a lessor, you have to record two things. That is right of use asset or right to use asset and lease liability. So in a journal entry, you know that both debit and credit must be equal. If credit of lease liability is X, okay, the credit value is X, then right of use asset is X plus Y plus Z. So many adjustments you are making to X, isn't it? So here there can be the initial value of lease liability is X, and you are making changes to this X plus Y plus Z, whatever. Y means initial direct cost and Z means dismantling cost. So if there is a difference in the credit and debit value, then what are you supposed to do? What can you do to this journal entry? If debit is greater than credit, then you need to balance. Yes, you need to make the adjustment for SOPL, for the profit or loss. So if the right of use is greater than SOPL, then you will be giving the balancing figure. The credit also needs to be increased, isn't it? So in the credit, you will be giving cash. The SOPL adjustment is happening only in the last. Now the cash adjustment is happening here. Cash is an SOFP item. Okay. So here, we understand what is the difference making. That is the difference that arises between the value of right of use asset and lease liability. It is these four items, isn't it? These four items: lease payment, advance, then initial direct cost, dismantling cost, and any incentives. Otherwise, the debit will be equal to credit. So when this four adjustments is arising, this is just an adjustment of cash inflow and outflow. Lease payment is cash outflow, indirect cost is cash outflow, then dismantling cost is cash outflow, and incentive received as cash inflow. What is the adjusted figure? This is probably a net cash outflow. When cash is flowing out, you will be crediting it. Okay, I hope you know that condition. If asset is increasing, if any asset is increasing, you will be debiting it. And if any asset is decreasing, you will be crediting it. Cash is a current asset. And if cash is coming, if there is a cash inflow, you will be debiting cash. And if cash is decreasing, then you will be crediting cash. So here in this journal entry, my point is cash is what makes the difference. So the remaining balance is credited as cash. That is the Y. Y is credited as cash in the journal entry. Okay, so your compound journal entry will now be like this. Debit right to use, credit lease liability, and credit cash. And what is the cash amount? Cash amount is the net figure of all these four adjustments, if there is some adjustment. Okay, so LSE have to record two things, right of use asset and lease liability. And this is the journal entry. Usually, journal entry from lease is tested. Okay. Then this was the initial measurement, initial value. What about the subsequent value? Subsequent measurement. Let's see the subsequent measurement of right of use asset and lease liability. The liability is subsequently measured using amortized cost model. We have already learned about amortized cost model in IFRS 9 financial instrument, isn't it? But here there is small difference. We'll see it in the next slide. Then subsequently, right of use asset is measured using cost model as per IAS 16. So consider this as a non-current asset, and as per IAS 16, you will be calculating carrying value, carrying amount equal to cost minus accumulated depreciation. And this carrying value will be taken to SOFP as a non-current asset. Whatever is the depreciation calculated on right to use asset, that will be taken to SOPL. Carrying value will be shown in SOFP and depreciation will be shown in SOPL. Now, in order to calculate the depreciation of right of use asset, what is the useful life? Depreciation equal to cost divided by useful life, isn't it? So, what is the useful life that you need to consider? If ownership of leased asset is transferred to lessee at the end of lease term, then the depreciation is charged over the asset's useful life. So, you need to see whether there is a purchase option or not. If there is a purchase option, then the actual useful life of the asset will be considered for calculating depreciation. Then, otherwise, if there is no purchase option in the contract, then depreciation is charged over shorter of these two. Shorter of useful life, actual useful life, and the lease term. Which among these is shorter? The shorter useful life is considered as the term for calculating depreciation, useful life for calculating depreciation. So you need to check whether there is a purchase option or not. If there is purchase option, then actual useful life itself will be taken. If there is no purchase option, then shorter of useful life, actual useful life and lease term will be considered for calculating depreciation. Okay, that is the subsequent treatment for right of use asset. Then purchase option. Purchase option is like now you have a contract. Let's say as per the contract, I am the lessor. I am giving the assets to you. Okay, I am giving the asset to SAC at a lease. The term is every year you will be paying me 10,000. Okay, the contract lease term is for 2 years. This is a 2-year contract, and these 2 years you will be giving me 10,000, 10,000. And after that, I'm giving you an option as per the contract. I'm giving Zach an option to buy this asset himself. Now the ownership is with me. For these 2 years, even if Zach is using this asset, even if lessee is using this asset, control is with me and the lessor. I didn't give the control, I didn't transfer the ownership. But if I'm giving an option to buy this asset or purchase this asset, then for this option, you will check whether this option is reasonably certain to exercise. If this option is made available and if it's reasonably certain, then in that case, this option is considered, taken into account. It's like now I give this option to buy. After 2 years, 2 years, this will be a lease. Okay, lease term. 2 years, this will be a lease. And the third year, if you want, you can give me some additional money and you can buy this asset. You can take this asset of your own. That is the contract deal. As per the contract, I'm giving you an option to buy this asset after 3 years. 2 years, we have a lease contract, and in the third year, if you want, you can buy this asset. And it is reasonably certain that Zach will purchase this asset. In that case, we establish that there is an option to purchase after the lease term. Well, if there is such an option, as per the contract, if you are giving an option to buy this asset after lease term, then your actual useful life will be considered. Actual useful life of the asset will be considered. Here the lease term is 2 years and actual useful life of the asset may be 10 years. So you can use this asset for 10 years. The lessee can use this asset for 10 years, isn't it? So in that case, depreciation will be calculated for the actual useful life 10 years. Otherwise, if there is no lease option, then the shorter of actual useful life of the asset and lease term will be considered. Here, lease term is 2 years and actual useful life in my example is 10 years. In that case, this shorter 2 year time period will be taken for depreciating the right of use asset. Got it? Yes, good. Now, we have one small concept. What if this is a short life asset, or a low value asset? If the lease term is short, if the lease term is less than 12 months, okay, that is a lease which is less than 12 months for 1 year, or if it's of low value, like a mobile phone, tablet, or any such short value asset, low value asset, then a simplified treatment is allowed. You need not recognize any right to use asset or lease liability. You have a very simplified treatment, accounting treatment. So all these lease rentals, less any incentives, if any, then they are spread over the lease duration and is recorded as expense in SOPL. So it's a simple treatment. You know, rental expense, isn't it? If you buy something for rent, then you'll have to pay rent every month. So this rental expense will be shown in SOPL. That is the treatment in SOPL. If this is a short life asset, that is, if the lease term is less than 12 months, or if this is a low value asset, an asset with low value, usually you don't have an like what, a margin. Any asset with less than 5,000 is low value asset. You don't have a rule like that. But for your examination, if it's an asset for less than 5,000, the value of the asset is less than 5,000, you can consider it as low value asset. Otherwise, it will be specified in the question itself. This is a low value asset. In both these cases, you just need to record the lease payment, the rental payment as expense in SOPL. Okay. That's the treatment for short life and low value assets. Then, subsequently, how do you treat lease liability? Subsequent treatment of right of use asset is clear, I guess. This asset is depreciated over the useful life. Okay, useful life is determined based on the purchase option. And subsequently, what about lease liability? We have discussed that lease liability is subsequently accounted using amortized cost model. Amortized cost model. Now, this amortized cost model application is based on whether the payment is in arrear or whether the payment is advance. If it's payment in arrear, if lease payment is every year end, payment is made in every year end, in that case, this is your format. Balance brought forward, opening balance plus effective interest. The rate will be given. So whatever is the interest that is calculated on this opening balance minus the lease payment. Lease payment includes four things we discussed, isn't it? Lease payment includes fixed payments, then option to purchase, option to exercise, termination penalty, all those things. So whatever is the lease payment, that will be deducted. Usually every year lease payment will be same. The actual fixed amount payment will be the same. So just as we did yesterday, opening value plus effective interest. One interest rate will be given in your question. So based on that percentage, you'll be calculating effective interest minus the lease payment. It is not interest payment, it is lease payment. You will be getting your closing balance. This closing balance, see here, if it's a 2 year lease, let's take an example of 3 year lease. Okay, you have 3 years, year 1, 2, and 3. In that case, whatever is the difference between the closing balances of first 2 years. Okay, the difference between closing balance of year one and year two, this will be current liability, and whatever is the closing balance for the first year, this will be your non-current liability. Okay, this is first year non-current liability, and this will be your second year non-current liability. This one. Then this will be your third year non-current liability. Okay. So my point is the difference between two closing balances represents current liability for the year. There are instances where in the question they will be asking you to separate between current liability and non-current liability. So this closing balance, this balance goes to SOFP. Okay. This is taken to SOFP as current and non-current liability. All these closing balances represents non-current liability, and whatever is the difference between first year and second year, that is first year's current liability. The difference between second year closing value and third year closing value, that is second year's current liability. Okay, that you have to keep in mind. This lease payment, it is taken to statement of cash flows. This effective interest payment, that is taken to SOPL as interest. Okay, so this is the treatment. Now, you have a small difference when the payment is in arrears. Every lease payment, you will be making it in the beginning of the year. If that is the case, if payment is in advance, then you take opening minus payment, because payment you are making first, isn't it? Then only you are calculating the interest. In the beginning of the year itself, after the opening date itself, you are deducting the payment from the opening balance. Okay, so this is since this is advance payment, the lease payment is made first. After deducting lease payment, you get the subtotal. So soon after the payment, see here, soon after the payment, whatever is the balance, that will be taken to SOFP. So here after payment, the balance is subtotal. We are having a subtotal here. That subtotal will be considered as non-current liability in SOFP. Okay. So this subtotal is non-current liability for the first year. This is the non-current liability for the second year. And difference between these two will be the current liability for year one. Okay. Difference between first years and second years will be current liability. CL. Okay. Now, after calculating the subtotal only, you can calculate this interest. Interest is calculated as a percentage of the subtotal. Okay. When there is advance payment, interest is a percentage of this subtotal. And after adding this interest to the subtotal, you'll be getting your closing value. This closing value will not be shown anywhere. So here, subtotal is the value shown in SOFP, and payment is the value shown in SOPF. And this interest will be taken to SOPL. Got it? Only a small difference between payment in arrears and payment in advance. You are following amortized cost model for subsequent measurement of lease liability. I hope it's clear. Yes. Good. Now you have one more small topic left in this lease payment. Sorry, lease, IFRS 16 lease. That is sale and lease back. Understand the situation. What is sale and lease back? Here, if I'm taking example of me and Hema, let's say I'm the seller. Okay, I'm selling my asset to Hema, but I am selling this only because I need money. Okay, I mean necessity. I have a necessity for money, so that's why I am selling this asset. This asset, let's say for example, this is my office building. So I cannot leave all my work and go, but I need money, so I'm selling my office building because it's my necessity. I'm forced to sell my asset. And I'm telling my necessity, my situation to Hema, and Hema is understanding the situation. And Hema told me that even if this building is now mine, you can use this building as your own. Okay, you can use this building for all your operations. So if it's a mutually understanding arrangement, then this is also called sale and lease back, but the treatment is different. Okay. But the second situation is me and Hema are not relatives or not friends. I don't know Hema. We don't know each other. She is a completely new person for me, and I'm not telling all any of my necessity to her. I'm finding a new buyer, and that is Hema. And to this buyer, I'm selling my asset. Okay, my building. I sold it to Hema, and later on, after 1 or 2 months, or maybe on that date itself, I'm discussing with Hema for a lease arrangement. Can I use this asset? If you don't want this building to use, Hema, can I please use this as my own building, as my office building? Is it possible to lease it? Okay, so if this arrangement is happening between a totally unknown party, or if like this, there is an actual transaction happening, if there is an actual transfer happening, then you are leasing it back. If that is the case, then you have a different treatment. So the first thing is you have to see whether there is an actual transfer. If an entity transfers an asset to another entity and then leases it back, then the IFRS 16 requires that both entities assess. They need to assess whether the transfer should be accounted for a sale, whether this is an actual sale or not. That must be tested. How can you test whether this is an actual sale or not? You have one keyword from IFRS 15, check whether control is transferred. Okay, if there is transfer of control, then it represents actual sale. If there is no transfer of control, then this is just a mutually understanding arrangement. There is no actual sale happening. For establishing an actual sale, the control must be transferred. I must transfer the control of this building to Hema. Then only we can say that actual transfer is there. So both these situations comes under sale and leaseback. But if the transfer is not an actual sale, if control is not actually transferred, in that case, this is treated as a loan taken. See, just imagine I was in need for money and I went to the bank. So bank is not going to give me money just like that. They need something for collateral. So I'm giving this as a security, my building as a security. I'm keeping this as a security and I borrowed money from the bank. So that itself, we are calling it as a loan. We are calling it as collateral loan or mortgage loan, isn't it? So whenever you are having this mutually understanding arrangement of a sale and leaseback, you will consider it as a loan taken because the control of this asset is not transferred. Now, tell me, in which standard did you learn to treat loan? What is the treatment of loan? At least give the standard number or name, whatever you remember. How to treat a loan? We learned it yesterday. Anybody? When you have bond, loan note, and debentures, which standard did you follow? What rule did you follow? No, it's not 23. Yes, it's a financial liability. You guys give me the example. Okay, we have IFRS 9 financial instruments where this contract is a liability for one party and for other party this will be a financial asset, isn't it? So that treatment is coming here as per IFRS 9. When you establish that this sale and leaseback is not an actual sale, then you consider this as a loan taken and you will treat it as a financial liability as per IFRS 9. Okay, as per IFRS 9, initially you value it at fair value. Initial value equal to cash paid minus cash received minus issue cost. Then subsequently you will follow amortized cost model and you will be treating this as a non-current liability. Then if it is an actual sale, if it is treated as an actual sale, then the treatment is as follows. But you don't need to go through these. I'll tell you what to do. If the treatment is actual sale, then two things are happening there. See, The first transaction is you sold the asset, and the second transaction is you are leasing it back. Okay, I don't know Hema. I'm giving my asset. I'm selling this asset to Hema. So, what is the journal entry? Tell me the journal entry for recording sale of non-current assets. How to record a sale of non-current assets? Yes. Debit cash, credit non-current asset. That is the basic journal entry. We have debit cash and credit non-current assets. Now, what is the second journal entry? When you are leasing back, you are the lessee. Okay, you sold the asset and you passed the journal entry, debit cash, credit non-current assets. But you are leasing the same asset from the buyer. I'm leasing the asset from Hema. So what is the journal entry from lessee point of view that I have to record? The journal entry for lease. Anybody? Just now we discussed the journal entry for lease. Yes, debit, right to use asset and credit lease liability. Yes, good. Debit asset and credit liability. So when you're naming it, it will be right to use asset and credit lease liability. Okay, now you need the values of all these. When you combine these two journal entries, you will be getting the treatment for sale and lease back. This is important. This is a very important journal entry that you need to understand. Debit cash, credit non-current asset, debit right to use, and credit lease liability. When you're combining these two situations, you will be getting a journal entry something like this. See, it will be debit cash, then debit non-current assets, debit right to use assets, then credit non-current assets, and credit lease liability. And what are the values of these corresponding figures? We need to know that. For cash, whatever is the sales proceeds that you received, that will be taken. Sales proceeds. Then, for right to use, you have to calculate it using an equation. Let's keep it there for now. For non-current asset, you are passing the journal entry debit cash, credit non-current assets. But you know this non-current asset credit means you are removing the non-current asset from the statement. An asset is reducing. So the value reduced is only the carrying amount. Only up to the carrying amount, you will be reducing the value of assets. Okay. So this sales proceeds in the journal entry, debit cash, credit non-current asset means what if the sales proceeds is not equal to carrying amounts? There will be a cash balance. Okay. You call it profit or loss. So the balancing figure, if the balance comes in, if there is a more amount in debit and in the credit there is less value, in that case you will be recording a balance in the journal entry that is credit. Okay, so if debit is greater, can you recognize a profit or loss? That is, if sales proceeds is greater than carrying amount, will there be a profit or loss? Yesterday we discussed. If sales proceeds is greater than carrying amounts, profit or loss? It will be a profit. Okay, so this profit is the balancing figure. And you will be required to calculate the value of profit. They'll be asking you, calculate the profit from this sale and leaseback arrangements. So in that case, you just need to solve this journal entry and find the value. Now you know what is the value for lease liability. For lease liability, you have to consider present value of lease payments. Okay, present value of lease payments. Now, what about the right of use? Rights to use. That is very important. You have a separate formula. Just 1 second. To calculate the amount of rights to use when there is a sale and lease back, it is you just need to apply this equation. See, present value of lease liability, present value of lease liability divided by sales proceeds multiplied by carrying amount. Okay, this is the equation. You have all these values here itself. Present value of lease liability you have here. Then divided by sales proceeds you have here. Into carrying amount you have it here. When you apply these values to this equation, you will be getting the value of right to use or right of use asset. Okay. So the journal entry will be debit cash, debit right to use asset, credit lease liability, credit non-current asset, credit lease liability, and the remaining will be credited as profit. And if the balance comes in debit, then it will be debit loss. Debit loss. So there can either be profit or loss. Both of them will not be coming together. So whatever is there in your answer, analyze and do accordingly. So this is a big journal entry, and this journal entry is very important. And this is the only thing that you need to understand from sale and lease back. Whenever there is an actual sale and you are leasing it back, in that case, you will be recording this journal entry. So whatever values you are asked for your examination, you will be finding that value based on this journal entry. What is the amount of loss? What is the amount of profit? What is the amount of lease liability? Everything you will be getting from this journal entry itself. Okay, I hope it's clear. So that's all about lease. IFRS 16 is done. Now your last standard is IAS 33, earnings per share. So I told you that yesterday. Our objective of learning all these standards is what? What is the objective of learning these standards? Anybody? Standards. Why are we learning these standards? Objective of learning standards. Simply for writing exam. Is that it? Aradhana, Hema, Tanmay, anybody? Shivangi? Why are we learning these standards? Yesterday we learned lots of standards. Today we learned 2 standards, IFRS 15 and 16. What is the objective of learning these standards? Ultimately. Yesterday we discussed it. Our objective is, yes, to know how to recognize it in financial statement, or to be precise, we can say that to know how to prepare financial statements. Okay, we are learning statements to present and to prepare financial statements. Very good. To prepare FS. That is why you are learning standards. Okay. Now, all these standards that we have learned till now, these standards, we are learning it to prepare statements. What value goes to SOPL, what value goes to SOFP. That's what we discussed. But now this last standard, that is IAS 33, that will not help you to prepare your statements. IAS 33, this standard is not going to help you to prepare your SOPL or SOFP. Instead, it will help you to analyze your statement. IAS 33, earnings per share. This standard will help you to make investment decisions, to analyze your statement and make investment decisions. Okay, this is your last standard and this is separated from all other standards. This will be tested separately as in your essay question, maybe a B requirement or a C requirement. Calculate the EPS. They will be asking you. Okay, so IAS 33 is nothing related to preparation of FS. All other standards are related to preparing financial statements. But IAS 33 will help you to make analysis and make investment decisions. Okay, now let's discuss the basic rules of calculating earnings per share. We have already discussed that our ultimate objective is to make investment decision. It helps investors to make investor decisions based on the performance of the company, and they will help you to compare your statements with different entities and compare the statement of same entity for different accounting periods. That is the objective of IAS 33. Now, IAS 33 can be divided into two. EPS, it has two classifications, that is basic EPS and diluted EPS. I'll show you everything here in this slide, the brief summary of EPS. The first one is basic earnings per share. Under basic EPS, you have a few things, and you have diluted EPS. Under basic EPS, you have four different situations that will be tested for your exam. The first situation is when you have full market issue of shares at market price, issue at full market price. That is first situation. Second situation is bonus issue. What happens if your company issues bonus shares? Third situation is rights issue. And finally, you have combined situation. Okay, during the year itself, you are having rights issue, bonus issue, market issue, everything during the year itself. In that case, there will be a different treatment, combined issue. Okay, so these are the four situations that you will be testing. You will be checking how to calculate basic earnings per share. Now, when it comes to diluted EPS, you only have two situations where diluted EPS is calculated. One situation is where there is convertible instruments. And the second situation is when there is options or warrants. Options and warrants are contract. It's not warranty, it is warrants. So options and warrants, and if there is convertible instrument, you will be calculating diluted EPS. And when there is issue at full market price, bonus issue, rights issue, and combined share issue, you will be required to calculate basic earnings per share of the company. Okay, just give me 1 second. Let me connect the charger. This is not a very important standard. So we'll be just roughly going through it, revising it. The basic EPS has a basic equation, that is earnings divided by number of shares. When you expand this equation, it can be like earnings means profit after tax during the year minus any irredeemable preference share dividend. Irredeemable preference share dividends. Okay, that is earnings. So this divided by number of shares means you have to calculate weighted average number of shares. This will be your expanded equation. Now, the second part is difficult. The denominator, weighted average number of shares. You have calculations in calculating the weighted average number of shares. The direct figures will be given for earnings, profit after tax, and if there is irredeemable preference share and all, it will be directly given. You don't have much to worry about the numerator. In the denominator, when you are calculating weighted average number of shares, you have to do some calculations. So this is the equation for calculating basic EPS in all situations. But when it is issued at full market price, then earnings should be apportioned over the weighted average equity share capital. So you only have to consider one thing, that is time apportionment. When there is issue at full market price, you have to do time fraction. From one share issue to the next share issue, what is the number of months? Count the number of months and apply this fraction to each balance existing. To the opening balance, there will be an opening balance of shares, the opening balance of share capital. To the opening balance of share capital, you will be multiplying the number of months, the time fraction from the opening date till the next date of share issue. Okay, if you are issuing shares on March, from January to March, your opening date is January. From January to March, for 3 months, you will be doing time apportionment, and the time fraction will be 3/12. Then, from March till the next share issue, if the next share issue is happening in July, then from March to July, you have March, April, May, June, July, for 4 months or 5 months. So for these 4 months, you will be calculating the time fraction, that is into 4/12, and this 4/12 will be applied to the balance that you have calculated on 31st March. Okay, on 31st March, that is on the previous share issue. Whenever a share issue is happening, you will be calculating new balance, isn't it? One first issue is opening. Then after that, you had a share issue on 1st or 31st March. Your next issue is happening in 31st July. In that case, with the opening balance of share capital, your time fraction will be into 3/12. That is from the 1st January till 31st March. Then you will be calculating a new balance in 31st March. The additionally issued shares, that will also be included in the balance. So now on this balance, you will be applying a new time fraction, that is from 31st March till 31st July. That is April, May, June, July, 4 months. So into 4/12. Now after that, if there is no issue, then you will be going for closing, isn't it? Closing balance as on 31st December. So from 31st July to December, you will be doing the next time apportionment till the closing date. You had 2 issues during the year. So when there is 2 issue, then this is how you need to treat, where if it is issue at full market price. Okay, so that's it. That's the only thing that you need to consider when the share issue is happening at full market price. When you are getting the total, you'll be that total is considered as your weighted average number of shares. Just as you see here. Here you have the dates. You have to keep this format. Date, then actual number of shares, year fraction, or you can call it time fraction, then total. The total figure will be considered as weighted average number of shares. Okay. So in every situation, if you have full market issue, bonus issue, rights issue, or combined share issue, in all these cases, you need to calculate weighted average number of shares using this format. Okay, starting from the opening date till the closing date. Okay, and whenever there is a new balance, on this new balance, you will be applying the year fraction if the share issue is at full market price. Okay. So once you understand the pattern, then EPS is very easy. The next situation is where you have bonus issue. When you have bonus issue, you are required to calculate bonus fraction. Now, what is bonus fraction? Bonus fraction is number of shares after issue divided by number of shares before issue. Usually in your exam, they will be telling you a sentence like there is a 2, 4, 5 bonus issue. In this case, from this sentence itself, you can tell me what is the number of shares before issue and after issue. You don't need to calculate the total number of shares after issue and total number of shares before issue. Okay, just the bonus issue sentence is needed here. Okay, if it's a 245 bonus issue, then bonus fraction is equal to simplified number of shares after issue divided by number of shares before issue. Yes, 7 is the number of shares after issue and 5 is the number of shares before issue. Very good. You had 5 shares in your hands before the bonus issue. So a person holding 5 shares is now eligible for getting additional 2 shares. So what is the number of shares after issue? You are holding 5 shares and you are eligible for 2 extra new shares, 3 shares. And this 2 shares is added to the 5 existing shares. So you have 7 shares after issue, and before the share issue, you only had 5 shares. So 7 by 5 is your bonus fraction. So likewise, can you tell me what is the bonus fraction for 148 bonus issue? 148 bonus issue. What is the bonus fraction? Number of shares after issue divided by number of shares before issue. What will be the fraction? Yes, very good. It is 9 by 8. So after issue, now you have 8 plus 1. You have 9 shares divided by before issue, you had 8 shares. So it will be 9 by 8. Yes, good. Okay. So this is how you calculate the bonus fraction. Now, why do you need this bonus fraction? What is the importance of bonus fraction? Whenever there is a bonus issue, you have a basic assumption. The basic assumption is that you are treating as if the bonus issue had always been in existence. You know the date of issue. Okay, let's suppose the bonus issue was happening during the year. In 1st July, this bonus issue happened, but you will be treating as if this bonus issue happened in the beginning of the year. Or you will be assuming that this was always in existence. In the previous year also, this bonus issue was there in existence. That is an assumption that you always have to keep in mind when there is a bonus issue. For calculating EPS, assume that the bonus issue had always been in existence. So in that case, this bonus fraction will be applied till the actual date of bonus issue. You had the bonus issue on 1st July, isn't it? So till 1st July, whatever is the balance, to all those balances, all those previous balances, you will be applying this bonus fraction to bring the effect of bonus issue. Since your assumption is bonus issue had always been in existence, you need to apply this bonus element to the previous balances also. From July, you'll have the actual bonus elements, but till July, whatever is the balances till July, on all those balances, you will be multiplying this bonus fraction. Okay, so when you are coming to that format, see, this is the basic format for calculating EPS, isn't it? In this format, just as you did year fraction, like that itself, you will be including one more item here called bonus fraction. Bonus fraction. For example, if you had a bonus issue on 1st July, then this bonus fraction will be applied only on the previous balance, that is the opening balance. So here you will be applying the bonus fraction 9 by 8 or whatever it is. Okay, so up to the date of bonus issue, till the date of bonus issue, whatever is the balance, till that balance you will be applying your bonus fraction. And this is based on an assumption that bonus issue is always been in existence. Then, whenever there is a bonus issue, you will be required to calculate the comparative or restated earnings per share. So, how do you get the comparative or restated EPS of previous year? Comparative EPS is equal to basic EPS of previous year into reciprocal of bonus fraction. If bonus fraction is 9 by 8, then reciprocal will be 8 by 9. So, previous year's basic EPS multiplied by reciprocal of bonus fraction. You will get your restated or comparative EPS. That's it. Now this combined situation is very simple. You already understood what is the situation for bonus issue and what is the treatment for full market issue. You just have to combine both. Apply bonus fraction from the start of the year until the date of bonus issue, and you need to do time apportionments for the number of shares to reflect the cash being received from market issue. So, full market issue, the treatment is the thing that you have to keep in mind is time apportionment. And whenever there is bonus issue, you have to think of bonus fraction, which is applied till the date of bonus issue. So in a combined case, whenever there is bonus issue and market issue combined, you will be applying bonus issue in the format, and you will be applying this time apportionment in the format. Next case is when the company is having a rights issue. They contribute additional resources. Rights issue means they are not actually free issue like bonus issue. Bonus issue is a free issue for existing shareholders, but rights issue means the shareholders will have to pay something, but they will be getting it at a discounted price. The shares will be issued at a discounted price. So in that case, you have a 4-step approach to follow. The first step is calculation of TERP. Okay, so in this slide, let's skip this slide for now. Understand that whenever there is rights issue, you can follow 4 steps. To calculate EPS where there is rights issue, you have 4 steps, and step 1 is calculation of theoretical X rights price, calculation of TERP. Start with the number of shares previously held by the individual at the market price, and then add the number of new shares purchased at the price, and TERP is calculated by dividing the total value by total numbers held. So here we have an example. Let's understand the concept with this example. If you have 143 rights issue for $3, what does this mean? For a shareholder who is having existing shareholding of 3 shares is now eligible for 1 additional share at a discounted price, and the discounted price is $3. Market price was $5. Okay, so the market price was $5, and this person having 3 shares minimum, he is eligible for 1 extra share at a discounted price, that is $3. This is the situation. In this situation, you have purchased 3 shares for $5. Okay, the market price is $5. So 3 shares in your hands has the value of $5 each. So 3 into 5, total value of your shares is of your 3 shares is $15. Then 1 new extra shares, you only have to give $3 for this extra share. So 1 into 3, you only spend $3. So what is the total value of the shares in your hand? Total value will be 18. 15 plus 3, that is 18. Then TERP is equal to total value divided by total number. So that is simply total value TERP equal to total value divided by total number. Okay, so this total value divided by total number means what? Total value is 18 for 1 shareholder, but the minimum total value is taken here, and total number here is how much? 4 shares I have. Okay, I initially had 3 shares. Now I got 1 extra share at a discounted price. So 3 plus 1, now I have 4 shares. So your answer will be 18 divided by 4. That is $4.5. This is your TERP, theoretical X rights price. Calculation of TERP is your first step. Now, step number 2 is calculating the rights issue bonus fraction. You can call it bonus fraction if you want. Okay, we can call it bonus fraction because we already calculated bonus fraction and we learned the equation of bonus fraction. So here you can call it rights fraction. It has a separate equation. Whenever there is rights issue, you have to calculate this rights fraction, and rights fraction is equal to market price before issue divided by TERP. Okay, market price divided by theoretical X rights price. That is the equation for rights fraction. Just as you did for bonus fraction, this rights fraction is applied till the date of rights issue. Whatever is the actual dates of rights issue, till that date, you will be applying this rights fraction. Okay. And in the third step, you will be calculating the weighted average number of shares, just as we did before. Okay, you calculated TERF in step 1. In step 2, you calculated the rights fraction. Now you are calculating the weighted average number of shares. We can calculate weighted average number of shares as usual using that table itself. The bonus fraction would be applied from the start up to the date of rights issue, but not afterwards. Okay, so this rights fraction, they're talking about this rights fraction, and this fraction will be applied till the dates of rights issue, but not afterwards. Okay, and why is this happening? This is because rights issue has the element of both bonus issue and full market issue. That is why they have to calculate this rights fraction, and we have to do time apportionment also. Okay, we need to calculate weighted average number of shares. Now, after calculating weighted average number of shares, you will get your, you can calculate your EPS. Basic EPS is equal to earnings divided by number of shares. So earnings means simply profit after tax minus irredeemable preference share dividend, whole divided by the weighted average number of shares. This will be your EPS when there is a right issue. Don't forget about TERP and rights fraction. To restate the prior year EPS, the restated EPS will be basic EPS of previous year into reciprocal of a rights fraction. Okay. Whenever there is a bonus issue and rights issue coming together in a question, then comparative or restated EPS will be basic EPS of previous year into reciprocal of bonus fraction into reciprocal of rights fraction. Okay, this is how you calculate the restated EPS in a situation where you have both bonus issue and rights issue. Okay, so that's all about calculation of basic EPS. Understand the equation, understand the step, and the calculation of weighted average number of shares is only needed. That is the important thing here. Then, our next subheading is diluted earnings per share. Diluted earnings per share, usually this convertible instruments case is only tested. You have two situations, that is convertible instruments, convertible bonds and convertible loans, etc. And the second situation is when there is options and warrants. These are the two situations where you calculate diluted EPS. And generally, this convertible instruments case is tested for the exam. So in that case, you have an equation here. Diluted EPS is calculated as follows. That is earnings plus notional extra earnings divided by number of shares plus notional extra shares. Now you need to understand what is notional extra earnings and what is notional extra shares. Let's see. When your company has a convertible instrument existing, then in that case, there is a possibility that on a future date, you will have to issue shares as per the instruction of your lender. Yesterday, we discussed the treatment of convertible instrument, isn't it? So, if I am the company and if I have issued convertible instrument to Atul, so in that case, Atul has an option now. Atul can choose whether the repayment he need in the form of cash or whether he need it in the form of my company's own equity shares. So if suddenly he is coming to my company and if he is asking me that I need your company's shares, I need repayment in the form of shares, then I'm obliged to issue the share, isn't it? So considering this obligation, we are calculating a diluted earnings per share. So what happens if you are converting your shares all of a sudden? What will happen? You have to assume that the maximum possible number of shares, the maximum possible dilution happens. That is the assumption. Assume that maximum possible conversion or dilution happens today. Even if it's not actually happening today, we are assuming, we are imagining that it is happening today. That is the assumption behind calculation of diluted EPS. Okay, assume that maximum possible conversion or dilution is happening today. In that case, three things you need to consider. The first thing is when Atul gave me money, this was a loan note. This is a convertible loan note that I have issued. So when he gave me money, I recorded this as a loan, okay, as a loan liability. And based on this loan, I will be giving him interest every year, isn't it? Atul will be receiving interest from me until the date of conversion. So on conversion, what happens? The actual PAT figure, if you are assuming that it is converted, now from this date onwards, you will not be paying the interest. Okay. Now Adil is not my debt holder. Adil is my equity holder. After conversion, when I convert this loan note into equity shares, and if I give my equity shares to Adil, now Adil is my equity shareholder. So I'm not supposed to give interest to my equity shareholder. What am I supposed to give Atul from now onwards? After conversion, what is the returns to shareholder? Anybody? It was initially a loan note. So based on this loan, I paid interest. Yes, very good, Hema. The dividends will be now my obligation. Okay. From now onwards, soon after conversion, now I am obliged to pay dividends instead of interest. So this dividend is not actually affecting the PAT, profit after figure, the earnings figure. It is not affected by dividend, but it is affected by interest. So after conversion, what happens is there will be an interest saving. You don't have to pay interest anymore. So this interest saved is therefore added to the profit after tax because in the profit after tax figure, this figure is arrived after deducting the interest expense. Now you have saved this interest, so you are adding this to your profit. Then, when your profit increases, there will be additional tax charges on the increased profit. So, if you are increasing your profit with the amount of interest, this increased figure will be obliged to, will be subject to tax. Okay, so the additional tax on interest that will be deducted from the PAT. These two adjustments will be happening in your numerator. And in the denominator, the number of shares will increase. The notional extra shares, when you are issuing shares, when you are converting your loan note into shares, there will be extra shares. So this extra number of shares will be added to your equation. Now your equation will be like this. When I'm expanding the equation, DEPS is equal to profit after tax minus irredeemable preference share dividend plus interest saved minus tax on interest saved. Okay, this will be your numerator. And your denominator will be weighted average number of shares plus notional extra shares on conversion. Okay. So when you apply this equation, you will be getting the diluted earnings per share. I already gave you an equation in the previous slide. DEPS is equal to earnings plus notional extra earnings divided by number of shares plus notional extra shares. That was the equation. So simply we can say that earnings means profit after tax minus irredeemable preference share dividend and plus interest saved minus tax on interest. This is notional extra earnings. Okay. Now, in the denominator, you have weighted average number of shares that is calculated as normal and the extra shares on conversion that is notional extra shares. When you apply this equation, you will be getting your diluted earnings per share. I hope it is clear. So that's all about IAS 33. The important areas of IAS 33. Which slide? This one? This equation? Yes, I've just expanded this equation. Earnings means profit after tax minus irredeemable preference share dividend. Notional extra earnings means interest minus tax on interest saved. Okay, this is the basic equation. But when you're solving a question, you need to understand what is notional extra earnings. How do you get notional extra earnings? Notional extra earnings simply means you are adding interest saved minus tax on interest. Got it? Yes. So that's all about IAS 33. Now we have completed the rapid revision session for all standards. Okay. Now let's take a 10-minute break and we will do the part that we have discussed before. I'll teach you how to prepare an essay question, how to prepare consolidated statement, how to formulate your answer for interpretations, then how to make use of my ACCA accounts. All those things we'll be doing after this, after break. Okay, or let's make it 5 minutes. The break will be from 6:15. It's now 6:15 till 6:20. You'll be back by 6:20 and we will continue. Okay. Can everybody please give me a response?
Yes, ma'am.
Yeah, yes. Today you guys don't have an energy like you had yesterday. Yesterday you were more energetic. Everybody was giving me response on time. Okay. So just freshen up, wash your face and come back. Then we'll revise the remaining. Okay. Yes. Good. Okay, hello. I hope you guys are there. Am I audible?
Yes, ma'am.
Yes. I hope you can see my screen. Log into my ACCA account first. I'm showing you how to access your past question papers and how to do the mock exams. Okay, so listen carefully. I need all of you to attend at least 2 mock exams before your main exam. Okay, you scroll down. In the end, you can see study resources here. Click on study resource. You have lots of supporting resources provided by ACCA. Okay, you can just select your qualification. So you can see all subjects here. Our subject is financial reporting. You select financial reporting. Now, if you scroll down, you have so many things based on FR itself. Introduction to FR. Let's see what ACCA have to tell about FR. But it's all now it's not the right time to look all these things. These is for you to understand the subject. Okay, what is financial reporting? Then, in exam point of view, how is financial reporting exam coming? All those things. Then you have exam team guidance. The examining team itself will be guiding you. What is their expectation? When they are giving such and such questions, they are expecting such an answer from you. So the examining team guidance is also there. The general approach to the syllabus and tips on how to improve your exam performance. That is given in the My ACCA platform. Then get ready modules to identify weaker areas and refresh your core knowledge. But I don't think this is of a very like what very big use, but still you can access all these resources. The syllabus, okay, whatever is the syllabus coverage, that will be provided here. Then examinable documents and this maths and English language support, that is not required. You can leave it. ACCA Study Hub, I hope you are all aware of ACCA Study Hub. The study material put forward by ACCA themselves. Okay, there are so many example questions, quizzes, then study modules, all those things covering each and every part of your syllabus. But the questions from Study Hub, I personally don't prefer doing such questions because in your main exam, I don't see such questions coming. Okay, but if you want, you can practice that also to boost your knowledge and confidence. Then here is the thing that we have past exams and question practice. So you just click here. Other than that, you have so many things: exam techniques, technical articles, and topic explainers. You have small topic explainer videos uploaded in the My ACC account itself. So this is a library of articles, videos, and podcasts to help you develop broader insight into the subject. Make use of this. Okay. Then exam techniques also you can use FR mock exam and a debrief video. So here, what as our priority? Our priority is past exams and the ACCA platform. We need to see how the ACCA platform looks. Okay, we need past papers and mock exams. So just click here. Then it leads to a new page. Here you can see login to practice platform. Click login to practice platform. You have all subjects here again. Now you can select FR. Click on this plus symbol. You can have a blank workspace. Sorry. Yes, you can have a blank workspace or you can have the ACCA resources. In this ACCA resources, here you have again the classifications, past exam library, then practice exams and specimen exam. So let's see what is inside this past exam library. See, you have FR March and June session exams, but this only contains two selected questions that they have assigned. Okay, then you have March June 22, then you have March June 23, March June 24, September, December 24-25, then September, December 21. So certain sessions they have given selective questions and they have uploaded here in my ACCA platform. You have 1, 2, 3, 4, 5, 6, 7, 8. You have 8 of them. Make use of these practice questions. So it's like these are past questions. I prefer don't go very far. Okay, here in the March, June 2021, it's like almost 4 years is over. Okay, so many sessions have been covered. So go for the recent questions. And even if you go for the past questions given in 21 also, it's not an issue because here it's still there in the ACCA site, which means that model question can also come in 2025 or 2026. Okay, so whatever is given here, you can go through all these past questions. But let me take one. These past questions will not be like what to say. It will not be like a full-fledged section A, B, and C question. It's only like you have the C part question. Let's select one randomly. Here you have March, June 23, 24. I just assigned it. Now, when you assign something, you can see it here. Okay, it will be coming here. Yes, FR, past and practice exams. This is March, June 24. Let's resume this. This is your ACCA platform. Your ACCA question paper looks exactly like this. It will give you an Excel sheet as your response area if they are required to do calculations. Otherwise, this response area will be a word sheet. So here, first, when you get a question, go through the requirements. You have 2 requirements for 20 marks. 20 marks, 2 requirements. First requirement is prepare consolidated statement of financial position for Paisley Group as of 31st December 2009 and it carries 18 marks. Then you have explain the rationale behind elimination of intra-group balances and unrealized profit in relation to sales made from parent to subsidiary. So we know what is intra-group transaction. It's simply whatever you know about intra-group transaction, you can explain it in 3 or 4 sentences so that you will get 2 marks. Okay, you can give 4 sentences for 2 marks, allocate like that. So whenever there is an intra-group transaction, you will be removing the value of intra-group transaction from both group receivables and payables. Then you will be removing the same value from both revenue and cost of sales. Okay, in SOPL, if there is an intra-group transaction, you will be removing this figure from revenue and cost of sales, this intra-group transaction figure. Then, if you are preparing consolidated SOFP, you will be removing this figure from group receivables and payables. And what is your objective behind doing this? So for one company, the seller company, they will be recording the intra-group transaction value. The transaction value is 10,000. The seller will be recording a receivable of this 10,000 and the buyer will be recording a payable of this 10,000. So there is no point in showing this in your statement. So this 10,000 value that you transferred from your one pocket to another pocket, okay, that you transferred from one member of the group to another member of the group, that will be removed from the group statement. Okay, like that itself, in one statement, you will be recording the seller statement, they will be recording this as revenue, and in the buyer statement, they will be including this within purchase. And purchase comes in cost of sales. Cost of sales is equal to opening inventory plus purchase minus closing inventory. So in this cost of sales figure, the buyer company will be including this intra-group transaction value, and in the revenue, seller company will be including the same figure. So when you're combining these individual statements, there is no point in including these intra-group value twice. In one company, it is a negative figure, and in the other company, it's a positive figure. For one, it's an expense, and for the other, it's an income. For one, it's an asset, and for other, it's a liability. So you have to explain all those things. Just 4 sentences. Whatever you know about intra-group transaction, you just give it for 2 marks. Okay. And for 18 marks, you are required to prepare your consolidated SOFP. Consolidated SOFP question is very easy. I'll possibly after discussing these my ACCA things, we will prepare a consolidated SOFP. We have 5 standard working notes, isn't it? We have 5 standard working notes for preparing consolidated SOFP. You need to by heart the format for preparing statements, and when you read the requirement itself in your answer key, in your answer sheet, you can go and give the format. Now you read the requirement, you didn't read the scenario. Soon after reading this requirement, you can take down the format. You can copy paste from your my ACCA, no, from your main ACCA exam also. Here, you are required to prepare consolidated statement of financial position for Pasley Group as at 31st December 2009. You can copy this and give this the heading, Control C, Control V. Okay, this is your heading. You can zoom this if you want. Okay. Zoom in and zoom out as possible. Then here, give the values. In a consolidated statement, first, assets. Under assets, you have non-current assets. Okay. Then, under non-current assets, there will be PPE, intangible, and you will be having goodwill. Don't forget. There can also be investments. Thus, investments includes anything other than investments, includes anything other than investment, the money invested in the subsidiary company and associate company. Other than investment in subsidiary and associate, everything will be coming here under investments. So these are the values under non-current assets. Then give the subheading current assets. Okay. So like that, you will be making a sample format for your consolidated SOFP soon after reading the requirements. Then after drafting the format, without reading the scenario itself, you can go for the next step, that is workings. Because for consolidated SOFP, you have 5 standard workings. Okay. Working note number 1, it is always group structure. Okay. W1, working note 1, group structure. Give the heading and do the workings. Working note 2, net assets of subsidiary. Working note 3, goodwill calculation. So before reading the scenario itself, you can do so many things. And this format has mark. If you don't have time, what you can do is, without reading this itself, give some random figures. PPE. It's like you don't have time for calculation. So you just add both of them. 2000 to 15,000 plus 87,000. Okay, give it here. Just leave it here. Without doing any calculation, if you are just combining the assets and liabilities of both parent and subsidiary, you will be getting marks on the basis of own figure rule, OWN, own figure rule. Okay, as per own figure rule, if your calculation goes wrong, you will lose the mark for calculation only. But if you understand, if the examiner can understand that you know the format and you know that consolidated statement is prepared by combining the statement of parent and subsidiary, that knowledge is sufficient for you to gain some marks. Okay, so don't forget about own figure rule. Don't skip any question. Attend all questions. Soon after reading the requirement itself, if it's SOPL preparation, go to the answer sheet and give the format of SOPL. If it's SOFP preparation, give the format of SOFP. Okay. So then, after doing whatever you can, then come to the situation, come to the scenario and read what is happening. On 1st January, Pursley has acquisition of 80% in Scottish. So all those things, there will be individual statements of parent and subsidiary. Okay, there will be a few adjustments and you are required to prepare consolidated SOPL. Okay, we are not doing this question now. We can do a very good question from the Kaplan kit, a question that has 2 subsidiaries. Okay, I'm planning to do it. Now, I just took this to show you the exam, past exam thing. Okay, you have to scroll down completely, then only we can move to the next slide. The second essay question given is based on using this information, calculate the basic EPS. Just what we discussed now. We are required to calculate basic EPS for 4 marks. Okay. Then there is a requirement B for 5 marks, calculating 5 ratios. So each ratio carries 1 mark. Okay. So you need to calculate the gross profit margin, operating profit margin, return on capital employed, current ratio, and trade receivables. Then for 11 marks, this is theory. Comment on the performance and position of a Ray company for the years ended 31st December 2009 and 8. So for the same company, you are making comparison over 2 years, over 2009 statement and 2008 statement. Okay. There can be comparison between two companies, between sector averages, and between a consolidated statement, whatever. This is a situation where you are comparing the statement of the same company over 2 different years. Okay. So, in this question, what you can do is first requirement is A. You only have a Word document. You don't have Excel here. So you need to make use of the functionalities of Word document. Okay. Here, your A requirement. I'm showing you how to give the answer of interpretation. Okay, interpretation is something that you don't need a revision. Okay, conceptual revision is not required. You have to read, you have to learn the equation. Okay, I can share the material. What is gross profit margin? What is net profit margin? All those equation you will be learning. Now I'm teaching you how to prepare. Okay, how to answer this question. So listen carefully. If you get such a question in your exam, we will do one question. I have selected a question of a fit company from the Kaplan kit. We can solve the question if there is time. But if there is no time, I need you to have confidence in doing this essay question of analysis and interpretation. Okay, you read the requirements. Now, section A is based on EPS calculation. So just give the heading, basic EPS is equal to earnings divided by number of shares, or you can expand the equation and give earnings by now weighted average number of shares. Okay, this is your equation. Now, based on this equation, you find the figures required for EPS, for earnings, and for number of shares. What and all is given in the question? Ray Company is a services company offering support and training to several large entities. So it's a service providing company. And its extract of financial statements. It may include SOPL extract and SOFP extract. So the relevant figures are given. Okay, it's not a whole SOPL and not a whole SOFP. The only thing given is whatever is required for us to do the calculation. From SOPL, they have given the revenue for 2 years, cost of sales for 2 years, and operating profit for 2 years. Then they have given extract from SOFP. Inventories, trade receivables, cash, these are all assets. Then equity part, ordinary shares, share premium and retained earnings. Then liability part, they have given loans, deferred income. Deferred income means based on government grant. Yesterday we discussed. Then for as current liability, they have trade payables, then other deferred income, and current tax payable. Okay, so these are all the extracts given from the statements of 2009 and 2008 and 9. Then there are a few adjustments provided. So based on all these adjustments and the given extract, you will be calculating and you will be calculating the ratios and you will be commenting. Okay, and always when you are solving a 20-mark question, focus on the marks. Okay, EPS calculation is only for 4 marks. So time management is important. If you have only very little time, then reading and understanding and calculating basic EPS will be time consuming. You can go for this gross profit calculation. See, profit margin calculation. This is for 5 marks. And comparatively, I feel this ratio calculation is easy if you know the formula. Okay, if you know the formula, if you have by hearted the formula, then this 5 marks you can score very easily. And commenting this 11 marks, this also is easy marks. You can give anything. It's based on your personal judgment. I can give you guidance on or instructions on how to give the comments. Okay, let me teach you. So based on A, this is EPS calculation. We need earnings and number of shares. Yes. I'll show you. I will show you how to calculate the how to give comments. Okay. So before that, let me go in this order. After doing this A part, you can directly go to B, give the subheading B. And in the B part, you are required to calculate these ratios. When you are calculating ratios, always make use of this table format. Okay, then it is more presentable. It's more attractive to the examiner. They also prefer doing this. So in the table, first column is for ratio, name of the ratio. Second column will be for 2007. Sorry, what is the previous year? 2008. And for the current year, 2009. You have 5 ratios down. 1, 2, 3, 4, 5. Okay, now give the table. The table comes. Heading is ratios. Here you have the ratio for 2008. This is the ratio for 2009. You need to make comparison between these two ratios, isn't it? So, first ratio that you have to do is gross profit margin. Second ratio is net profit margin. Isn't it? What is it? Yes, net profit or operating profit margin. Then you have ROCE, current ratio, and receivable collection period. Next is ROCE, current ratio, and receivable collection period. Okay, so these are the ratios that you are going to calculate. You can bold the headings if you want. Bold function is available for ACCA also. And for 2008, you can do the calculation in your calculator itself because this is not an Excel. So you can give the equation here. Gross profit margin equal to, the equation is gross profit by revenue into 100%. So here, what is the gross profit? From the statement for 2008, gross profit is 38,750. You can copy it if you want, or you can type it 38,750 divided by sales revenue for the year. It is 63,400. 63,400 into 100%. So what is your answer? Whatever is the answer, you can give here itself. 38,700. Sorry, 38,750 divided by 63,400 into 100%. Your answer will be in percentage. You can give the answer here. It is, let's assume, for example, it's 12%. I don't know. This is not the actual answer. 12 is not the actual answer. You can solve it if you want. Okay. So this answer, whatever is your percentage, you will be giving it here. Then net profit margin is equal to net profit by revenue into 100. Net profit is the operating profit. Operating profit is for the 2008 is 3,350 divided by revenue 63,400 into 100%. It will be whatever you can get. It is let's assume it's somewhat like 8% or 10%, whatever. Okay, so you have gross profit margin, you have net profit margin, then ROCE also. Everything you have to apply the equation. It's not necessary that you need to give the equation for 5 marks. Okay, for 5 marks, it's not necessary that you write gross profit margin divided by sales revenue into 100%. That is not required. Just give the value substituted equation, value substituted formula, and the final answer. You can bold the final answer. Gross profit margin for 2008 is 12. Then net profit margin for 2008 is 10. Like that itself, solve for 2009. Now your B part answer is very presentable. Like that itself, you'll do ROCE. Then you'll do current ratio is equal to current asset divided by current liability. Then receivable collection period. All values required will be, you can get it from the statement, the extract given in the question. Okay, all necessary information will be provided. So this is how you attend B part and you score 5 marks. Okay. You need ROCE also. Okay. Can somebody please give me the value? This 12% and 10% is wrong. Okay. Why? Differently in the sense you have two equations for calculating capital employed. ROCE equation is same only. Equation is PBIT by capital employed into 100. This is how you calculate return on capital employed. Your PBIT means operating profit itself. The operating profit for the year is how much? It is 3,350 divided by, you need to calculate capital employed. Capital employed has two equations. Anybody? Do you remember? If you follow either of these equations, you'll be getting the same amounts. What is the equation for capital employed? Anybody? Yes, you can go for total asset minus current liability. It is not asset minus total asset minus total liability. It's not like that. It is total asset minus current liability. Or you can say long-term debt plus equity. So where people go wrong is when you say asset minus liability, you'll think that it is total asset minus total liability. So total asset minus total liability, you'll get the equity element itself, isn't it? And Shivangi, when you say debt plus equity, you'll think like it is overall total debt plus total equity. But it's not like that. Long-term debt plus total equity. That is the equation. So if that is confusing you, I'll give the equation here. Capital employed. Capital employed can be calculated in two ways. You two are correct. Shivangi and Zabri, both of you are correct. But to be more specific, one equation is total assets minus current liability. And the second equation is total equity plus long-term liability, or we can say non-current liability or long-term debt, whatever you can call it. So applying either of these equations, you can get the value of capital employed. From this question, we have total asset here, isn't it? This is not total asset. This is only current assets. We don't have non-current asset here. So we can go for the second equation. Total equity 41,200. Okay, equity is 41,200 plus non-current liability. What all are included in non-current liability? For that year, it is only 8,000. These are all liabilities. Okay, 3,050 is the total liability, but we are not taking total liability. We only consider 8,000. Okay, 8,000 is the non-current liability. So your answer will be 49,200. This is your capital employed. Okay, or you can do it here itself, 41,200 equity plus non-current liability. That is into 100. What is your ROCE? Let me calculate. You have the calculator here also, Tom. Here, see on the screen you have calculator. You can make use of this calculator during exam also. And you can carry your calculator, whether it's a remote or center-based exam. You can keep the calculator with you. And if you don't have a calculator, don't worry. In the screen itself, you have a calculator here. So in this calculator, but I don't prefer this calculator. It don't look good. It doesn't look good. So we have 3,350 divided by oh my god 41200 plus 8,000 into 100%. So when you multiply by 100, it will be 6.8%. Okay, so your ROCE is 6.8%. Okay, you can just highlight it. Got it? For both years, you will be calculating ROCE. Then current ratio is current asset by current liability. Receivable collection period is uh, rece- receivables divided by credit sales into 365. Usually in periods, if they have not asked you specifically, you'll be calculating it in days. If they are specifically asking you to calculate the period in months, then you'll be multiplying it by 12. Okay. Yes. So that's how you do the calculation part for ratios. Okay. You need to by heart the ratios. You need to understand and by heart this ratios. Okay. It's not just by hearting. You need to understand what is gross profit margin, what is net profit margin, what is return on capital employed. Okay. All those things. And this formula sheet, I can share it with you. But I think the in the group it is admin only. So you can text me personally. Okay. I'll share you all those sheets. I have the formula sheet. I have the compressed the revision notes for all standards. Then I'll share you the question numbers in Kaplan, the reference numbers for IAS 16, IAS 20, whatever, for all standards. What is the reference for section A and B questions in Kaplan? Okay, all those things I can share it with you. Now let's continue with this solving part. I'm not actually giving you a final answer. I'm teaching you how to attend an ACCA exam. This is your actual platform. When you are attending exam on 5th June, this will be the screen that you are seeing in front of you. Okay, and an essay question, 90% chance is that you will get an essay question from ratio analysis and interpretation, and it will look like this. Okay, they will be asking you to calculate a few ratios, and they will be asking you to comment on the ratio. Okay, here when you have calculated capital, the ratios, then we can go for part C, that is commenting part. Now, this is the part that you all need to understand. You all need to have a proper order, okay, proper presentation, because section A and B, it's computerized correction. Okay, no invigilator, no examiner will be there. But section C, it is corrected by examiners only. Invigilators will be there. Okay, so these people, they are all humans, isn't it? As a human being, I also value the presentation. Okay, if it's a well presented thing, I feel like giving more marks. So, like that, your answer should be structured. It should be well presented. So, when I say presented, you can give a format like this. Initially, give an introduction. Introduction. Your C requirement is comment on performance and position. You are required to comment on the performance and position of a company. So, give introduction. Then, under this introduction, you can give one or two sentences. Okay, we are going to calculate the like what can we say? This includes the analysis of the performance and profitability of Ray Company and a comparative discussion based on the performance and position of position ratios based on the performance and position ratios for the year ended 31st December 2008 and 2009. Okay, that is one sentence. Okay, so this includes the analysis of performance and profitability of Ray Limited, and we are making a comparative discussion based on the performance and position ratios for the year ended 31st December 2008 and 9. And you can give what all ratios you are taking into consideration. The discussion will be about the profitability ratios. Performance ratios can also be called as profitability ratios, so you can use these terms interchangeably. So the discussion is based on the gross profit margin, net profit margin. You can give whatever you feel like, your own sentences, just two sentences, and it is not for scoring high marks. Just make your answer presentable. So in two sentences, you can say what are you going to do? What is the main body about? So given about, we are going to analyze the Ray Company's statement over 2 years, 2008 and 9, and we will be making use of profitability and position ratios. Profitability ratios includes GP margin, NP margin, and ROCE, and position ratios here includes current ratio and receivable collection period. These are position ratios. And if you want any other position ratios, you can calculate that also. If you want, you can calculate quick ratio. If you want, you can calculate inventory turnover period. Okay, that's your wish. For commenting, if you feel like that calculation is required, you can do that calculation. Otherwise, whatever you have calculated in B part, based on this calculation itself, you can do the commenting. Okay, so your introduction will be like this, what you are going to do in the body. After introduction, give the first subheading. First, you are going to comment on the performance of Ray Limited. So give the subheading performance. Performance of Ray Limited. Okay. So under performance, if you want, it's like the ACCA don't prefer bullet answers. So you are not supposed to give the answers in points, in bullet points. You will be giving in paragraph wise. But they themselves prefer answers in short paragraphs. Then it becomes more clear. Like your point will be expanded to two or three sentences, maybe four. Okay. In one paragraph, you can have three or four sentences. And just move to the next paragraph. In four sentences, you will be explaining one point. Then next four sentences for the second point. That's how you solve it. Okay, so performance, I'm going to analyze the performance of the company based on profitability ratios. And the first ratio that I'm looking is gross profit margin. Gross profit margin. Okay, so give the heading like this. After underperformance, you are considering gross profit margin. So here itself, you are giving three things in sentence form, okay, in paragraph form. You are not giving it in the bullet format, but here for you to understand, I'll teach you how to frame an answer. Listen carefully. Here you have gross profit margin for 2 years. For the first year, it's 12, and for the second year, let's assume it 15%, or let's say it's 13%. Okay. For 2009, it's 13%, the gross profit margin. So when you're commenting, comment like this. The gross profit margin the GP margin does not show a significant change from 2008 to 2009. So your profit is somewhat stable. You can comment like that. The profit margin is somewhat stable. Okay. Then if this was and if this is your comment, this is your first sentence. Now based on this first sentence, you will be giving your reasoning and why could this be stable. It can be like you don't have any new events happening, you don't have any new products introduced, you don't have a change in your selling price, so everything is constant. Since there is no new event happening between these 2 years, we have the gross profit margin as constant. Okay, so it's actually a good thing only. You can comment like that. But commenting usually comes where there is a huge difference. Let's say now the profit is 25 percentage. The gross profit from 12 percentage, it has changed to 25 percentage. In that case, what will you do? We can say that the gross profit margin has a significant increase. Significant increase by how much percentage? What is the percentage increase? Can somebody tell me the percentage increase? Do you know how to calculate the increase percentage? From 12 percentage to 25 percentage. You can give me the equation or you can give me the percentage increase. This point scores marks. I'm going to tell that the gross profit margin has a significant increase by 4 percentage or 5 percentage. How can I get this change percentage? Anybody? It's change by base into 100. That is how you calculate the change percentage. Okay, keep this equation in mind. Change by base into 100. So from 12, now it has become 25. Okay, you had 12 in 2008. Now it has become 25. In that case, the change percentages, it is not just the difference. Okay, it is not the difference between 25 and 12 percentage. Don't think like that. It is change by base into 100. So the change here is the difference between 25 and 12. What is the difference? Difference between 25 and 12. Anybody? You don't have a calculator with you? Yes, 13. Good. So this is the change. 13 divided by base. Base means whatever was the first thing. Okay, from 12 to 25. So base is 12. So change by base into 100. That will be your percentage. So 13 divided by 12 into 100. Okay, what is the change? That is 108 percentage. So there is an increase by a significant increase by 108 percentage. It's more than double. Okay, so we can see the double of 12 is 24. Okay, initially it was 12 percentage. Now it's more than double of what we had in 2008. So this is how you calculate the change percentage. This gets scores a mark. The gross profit margin has a significant increase by 108 percentage from 12 percentage in 2008 to 25 percentage in 2009. Okay, after giving the sentence continuously, you can continue it by giving an explanation. The second sentence is always very important. That is the reason. This could, always use could or maybe. This could be because of the change in selling price or the introduction of a new product or the change in sales mix. So whatever, there can be lots of reasons. You need to learn it from your study text. Okay, or if you feel like in your own mind, if you're feeling this could be the reason, you can give that also. Your personal judgment scores marks here. So I'm giving you the pattern to solve. Okay, under gross profit margin, first to discuss whether there is an increase or decrease and at what percentage there is the increase. Then this could what leads to an increase in gross profit margin. Learn it from your text. This could be, there are so many factors affecting gross profit margin. Okay, the selling price, the sales mix, the production overhead, okay, direct cost, all those things will be affecting the gross profit margin. So whatever is affected, as the gross profit margin is affecting, that things should be included here. So the change, this could be because of a change in selling price or introduction to a product. You can give one sentence like this. Now you need to go through this scenario. Okay. In the scenario, they will be giving you something, some clue based on why this happened, why this huge increase in gross profit happened. Refer the question and see, let's say, one of Ray Limited's directors set up Kylo, a business in direct competition to maintain its sales levels. Ray reduced its prices by 5% and extended the payment terms to significant customers. So they reduced their prices. So we can say it like that. So in this situation, this will probably be a decrease. Okay. The initial, this is just an example, isn't it? So initially in 2008, you can have an increase, and in 2009, you will be having a lower value. Okay. In 2008, it can be 25, and in 2009, it can be 11 or 10, whatever. So this is the clue for that. Why is there a decrease in 2008? From 2008 to 2009, what leads to a decrease? Let's give it like this. Here in 2008, it was 20. I'm not sure it's like that. This is the third example that I'm giving you. And in 2009, if it's 15%, in that case, you will be giving the same. There is a significant fall by, or there is a significant decrease by 108%. It's not 108, it's XYZ, whatever. From 15% in 2000, no, from 20% in 2008 to 15% in 2009. And this could be because of a change in selling price, a decrease in selling price, or introduction of a new product, or change in sales mix, whatever. So now give the reference from the company. Give Ray Company reduced its prices by 5% and extended payment terms to significant customers. So extended payment terms means this will lead to an increased receivable collection period. Okay, we are going to comment about receivable collection period also. So everything that you learn, that you read based on the scenario, these are clue for you to discuss about the ratio. Okay, so I'll give you a pattern here. Now I got 3 sentences. Now let's see if this is a good thing or bad thing. This is a concern. So this is a decrease in gross profit margin. So this is a concern for Ray Limited, Ray Company, which needs to be addressed immediately. Okay, so you can tell that this gross profit margin fall from 20 to 15%. This fall within 1 year, this 108% of fall, this is something that you need to consider as an emergency. You need to find a solution to increase your profit margin. Otherwise, the company will be facing a downfall. Okay, so like that, you can give your own comments. Now, since I'm teaching you, I'm making it short and crisp. But still, I got a new paragraph with these much, like what, with such length. Okay, so that's enough. Now go to the next one. Next is operating profit margin. Operating profit margin. So whatever you feel like has affected the gross profit margin, that you can comment here. Okay, whatever is affecting net profit margin, that is your concern next. In your net profit margin, first see whether there is an increase or decrease. Okay, increase or decrease. Okay, and if you are able to calculate the percentage difference, that is good. Calculate percentage difference. Then, secondly, in the second sentence here, you can give a possible reasoning. Give a possible reasoning. Give a What could have led to a decrease in gross profit margin? What could have led to an increase in operating profit margin? All those things. If it's an increase, then give a reasoning for increase in operating profit margin. If it's a decrease, then give a reasoning for a decrease in operating profit margin. Possible reason. Okay. Then, in the third sentence, based on operating profit margin, you're commenting on performance. Performance is your main heading. First, you are commenting on gross profit margin. Then you are commenting on operating profit margin. Then give a possible reason. After a possible reason, then you can give connect to the scenario. From the scenario, see if this possible reason is there or some other reason will be there. If you can give any connection, this leads to high marks. Okay, connection to the scenario and possible reasoning. These two sentences will give the mark. Okay. Then after connecting to the scenario, give a suggestion what you are supposed to do. Is this an emergency or is this something that can be left behind? Or is this a good thing? Oh wow, this is wonderful. The company has an achievement. So give a suggestion. Okay. If this is a downfall, then to improve, what can you do? So these four sentences are enough. Okay. Based on gross profit margin, you found that there is an decrease by 108 percentage. Then you gave a possible reason. This could be because of change in selling price or introduction of a new product. Then from the scenario, you gave the connection. Ray company reduced its prices by 5% and extended the payment terms to significant customers. This could have led to, we can give one more sentence. This could have led to this downfall in GP margin. Okay. Now, after that, you can tell that this is a concern for a company which needs to be addressed immediately. Okay, 4 or 5 sentences. Now, like that itself, you need to see the operating profit margin, whether there is an increase or decrease, and what is the difference percentage. Then give a possible reason for this increase or decrease. Connect to the scenario and give a suggestion whether this is a good position, whether this is a bad position, whether you need to adjust, address it immediately, or anything. Okay, you can give your own suggestion. Now, like that itself, based on performance itself, you will be using ROCE for commenting. ROCE, return on capital employed. Follow the same pattern. Okay, see if there is an increase or decrease. Give a possible reason for increase or decrease in ROCE. Then connect to the scenario and address this equity. What this ROCE is, if there is a change in equity or asset or liability, that will be affecting the capital employed. If something happens to the capital employed, that will be affecting the figure of return on capital employed, isn't it? So this ROCE can change if the company has switched from revaluation model to cost model, or from cost model to revaluation model. Or let's say if you are comparing between companies, then the policies of two companies will be different. Okay, there may be a new share issue. So whatever is happening during the year, all these points can be included. You can just copy this point and paste it here. All these points will have something to do with this change, obviously, isn't it? So connect a sentence from the statement. You need to read this question carefully. Okay, that is time consuming, I know, but when you read it once itself, you understand the situation, understand the situation of the company. So if you are reading the situation of Ray company, you think that you are a part of Ray company, you are Ray company. For you, what is the current situation? Did you introduce a new product? Did you change your selling price? Did you have a new customer? Did you have a bulk supply? Okay, all those things you have to think when you are reading this question itself. So after calculating ROCE, now you have already written, already discussed about so many things. This could carry like 2, 3, 4, 5, 6. Somewhat 6 marks you got from here. Okay, 2 marks for gross profit margin. You need to allocate it like that. 2 marks here. Then for this, for discussing about operating profit margin, you got 2 marks. Then when you discussed about ROCE, again you scored 2 marks. Now you got 6 marks. Okay. Then next, give the next heading. Yes, sure, you have to do it. It's not like can we, you should do it. Just now, that is your first objective. The ACCA examiners is also providing the guideline. What a student should first do is you need to allocate the marks yourself and plan accordingly. That is more impressive to the examiners. But it's not like you don't have to give this 2 mark in your answer. You just keep this in mind. Okay, for the examiner to analyze, this is for 2 marks, this is for 2 marks, this is for 2 marks. Okay, I didn't get, nobody told me that this 11 marks is allocated in this manner. I only decided this. Okay, so as a student, you are also required to do this yourself. You need to allocate marks for your answers. Okay, so for 11 marks, think how can you allocate this 11 mark for your answer? Okay, yes, good. So next, your next heading is, now you discussed about position, sorry, performance. Your next heading will be position. Okay. We are going to analyze the position of the company. We already analyzed performance or profitability. We can call it performance analysis or profitability analysis. So this is how we analyze the performance of the company. Okay. Now we are going to the position. To analyze the position of the company, we have already calculated 2 ratios. These are position ratios. Position ratios can be classified into 2, liquidity and efficiency ratios. Or you can call it working capital ratio and efficiency ratio. Working capital ratios are current ratio and quick ratio. Then you have efficiency ratios that are inventory turnover period, receivables collection period, and payables payment period. So all these ratios helps you to understand and analyze the position of a company. So first, we are going to analyze the company based on current ratio. Okay, current ratio is always represented in times. It is not in percentage. Here, your answer will be in times. Let's say initially it was 1.5 times, not times, it's in ratio. 1.5 is to 1. The ratio is represented is to 1. Now it is 3 is to 1. Okay, now the ratio has become 3 is to 1. Okay, current asset minus current asset divided by current liability. That is current ratio. Current asset divided by current liability is to 1. Okay, that is how you give your answer. So initially it was 1.5 is to 1 and now it is 3 is to 1. So how do you address this change? Just as we did here, just see if there is an increase in current ratio from the previous year or if there is a decrease. Okay, then you have to quote the increase or decrease based on the percentage difference. Then give a possible reason for this increase in current ratio. Only 2 items are affecting current asset and current liability, isn't it? So if there is any effect in current asset or if there is a new current liability, if you are, since here it is mentioned that Ray has recognized 5 million, not this. What can I say here? The first sentence, I only read this sentence, but based on this sentence itself, so many points are coming to my mind. Okay, so they extended the payment terms to significant customers. This means that the receivables has increased. Okay, so since there is a receivable increase, this will affect the current asset. That is why the current asset has increased. Sorry, current ratio has increased from 1.5 to 3%. Okay, so since current asset has increased, the current ratio has increased from 1.5 to 3%. Then connect to the scenario and give a suggestion. Okay, so this is the same pattern that you need to follow again. and you will be getting 2 marks here. 2 marks for discussing. So the main highlight is the first 2 points. Okay, give possible reason and connect to the scenario. If you simply say that there is an increase and if you are simply giving a suggestion, then it may not give you any marks. Okay, because anybody can do this. You already scored marks in B for calculation. Now, if you are telling from 2008 to 2009, there is an increase. Anybody can do this judgment, isn't it? So for that sentence, you will not be getting any marks. With that sentence, you should be incorporating the possible reasons and you need to connect it with the scenario and provide a suggestion. Then only you'll be getting the marks, relevant marks. For current ratio, just do like that, you got 2 marks. Then next is receivable collection period. For receivable collection period also, you're following the same thing. Okay, so now for this also you got 2 marks. Possible reason, connects to the scenario, give a suggestion. Okay, you got 2 marks. Then finally, now you are only asked to discuss about the performance and position. Sometimes they will be asking you to discuss about the gearing of the company. Sometimes they will be asking about the investment decision making. Okay, so here only performance and position is required. So we calculated performance ratios and position ratios and we discussed on it. Finally, this is very important, give a conclusion. Okay, you need to give a conclusion wherein you are discussing about the actual performance of the company, overall performance of the company, and overall position of the company. You can discuss that. The profitability, the overall, we can say the overall profitability of, and make sure that you use the name of the company here and there, of Ray Company has decreased from 2008 to 2009. Okay, this decrease is represented by whatever reasons you have given here. That itself you can copy here, no issues. Okay, but you need to give an overall comment on the profitability and an overall comment of the position. The position, you can say the liquidity position of the company has increased or decreased, has decreased based on your judgment. Okay. Yeah, here we have an increase itself, isn't it? Current ratio has increased. So we can say that there is an increase in liquidity position. Okay. Liquidity position of a company has increased. And this leads to an opportunity for investment. This leads or this creates an opportunity for investment. You can comment something like that. And there will be more points for you for sure because you have already commented on gross profit margin, operating profit margin, ROCE, current ratio, and receivable collection period, isn't it? Now you will be concluding everything. What is the overall profitability? What is the overall performance of the company? How is it? Then comment on the position of the company, liquidity position and efficiency. How efficiently the receivables are collected, how efficiently the payables are being provided. All those things you can comment, maybe in 3 sentence or 4 sentence, and you can allocate the remaining mark here. Okay, for conclusion. So how much mark did we score for this? 2 3, 4, 5, 6, 7, 8, 9, 10. So out of 11, you have the capability of scoring more than 11. Okay. If you want, you can do more. Okay, you have lots of options. What you can do is you can calculate the ratios which they are not, which is not required. Okay, just like inventory turnover period, payable payment period, quick ratio, all those things. If you want, you can calculate and you can comment on it. Okay, so now we have done everything for 11 marks. Okay, this is how you do. You solve a question. No, sir, not solve. You comment on interpretation question. Is that clear? It is very easy. It's not as difficult as you think. But if you read an answer in your textbook, it will be like they have written so many things. Okay, there will be a big paragraph. But understand that the examiner is not expecting that kind of answer from you. Even in the textbook, that they have written this. Okay, we have examiner's report in my ACCA portal. So in that ACCA site also, they have commented that they are not expecting such answers. Just as given in the plan, there will be a huge paragraph. So such answers are not expected from the students. From the students, they are expecting a well-structured answer with the relevant points. Okay, the relevant points includes the possible reason and the connection to the scenario. Read the scenario and connect. This could be the reason for a decrease in gross profit margin. This could be the reason for increase in gross profit margin. Okay, and give an introduction and a simple conclusion. That's it. You scored full marks. Now you understood how to solve a question for interpretation. Just now, is that good? For every question from interpretation part, you can do this pattern. You can follow this pattern very easily. I'm sure that you can score full marks. It's not a difficult thing to answer these 4 questions. It's 4 simple questions. Increase or decrease? What could be possible reason? This you have to learn from your study text. Then connect to the scenario that you have to do at the exam itself. Then give a possible suggestion. That is your own thing, your own judgment. Okay, personally, what you feel, you can give it in 1 sentence. That's it. So when you give the answer for all these 4 questions, you will be getting your final answer. Yes, thank you. And one more thing I have to tell you is based on interpretation, you will be getting questions from either of these. Okay. One situation is just like what we did with, now. They will be asking you to compare between your own FS, between 2 different years, just like we did for 2008 and 9. Years for same company, then maybe statements FS of 2 different companies. Maybe they will be giving you some pre-calculated percentages. Okay, it may not be like this. They will be giving you the gross profit margin of the sector is 10%. The gross operating profit margin of the sector is 20%. They'll be giving you like that. So this you have to compare with given sector averages. Okay. Or you will be required to compare with a statement FS before and after consolidation. You will be commenting based on whether the consolidation, the acquisition decision was good or bad. Okay, after acquisition, is there an increase in gross profit margin? Everything is similar only. Whatever we have done now, that is the exact same pattern that you need to follow for exam. For this calculation part, to make it presentable, give a table. That is good. Then for C part, I mean for your theoretical area, it carries approximately 10 to 15 marks. So for that part, give a proper structure and introduction, whatever you are required to comment upon, this is subheading, then a final conclusion. Okay, so in all these situations, whatever they have asked you to compare with, you will be following the same pattern. Okay, but read the scenario, connecting to the scenario is important, and that is very simple. Okay, even if you don't know anything, now that's my point here. You have learned nothing about financial reporting. You know nothing. So directly go to the section, C section. You have this question there, and this question is completely based on your judgment. You don't need any additional knowledge from standards here, isn't it? Okay, you don't need IFRS 1, IAS 16, IAS 20. You don't need the knowledge of anything. Even if you don't know anything, you can score this 20 marks based on your personal judgment. Okay, so that's about interpretation part. Make sure that you learn all formulas well. Okay, and the possible factors that could affect gross profit margin, net profit margin, ROCE, everything that will be given in your textbook. Just as per my plan, I have given you 1 day. Only 1 day is enough for you to understand this. Okay, I hope now you are confident about answering this final question. Okay, it's easy. When you're reading the answer from your plan, it seems that there is so many things that you cannot do. Okay, it's okay. Now we can go for the consolidation part. We have somewhat half an hour left, isn't it? Can we prepare a consolidated statement? Everybody? No, before that, I need to show you how to access this mock exam, isn't it? Yes. Here, this was a past question paper. We attended a past question paper. From this, see back here, we have just this slide, this page itself. We have financial reporting here. Go to ACCA official resources. Here you have practice exams. Okay, click on this plus symbol. You have FR practice exam 1, FR practice exam 2, and pre-June 2025 mock. Okay, so you can attend all these questions. Then also you have specimen exam also, FR specimen. All these are exam pattern. Okay, so now let's take the specimen exam. See, I've assigned it. Specimen exam. It will be coming here. Once you assign, it will come here in this side. Here, FR specimen. You can click on start. Now, since I've already opened, you have resume. Okay, your exam page will be like this. Initially, you have section A. In section A, you have 15 OT questions. Okay, objective test questions. Each carries 2 marks and total 30 marks from section A. Your exam page will also be like this. Here, this is your first question. Which two of the following requirements of preparing consolidated financial statements? Okay, are requirements for preparing consolidated statements. Read the 4 of them and give me an answer. We are anyway going to discuss about consolidation next. So give me an answer. All subsidiaries must adopt the accounting policies of the parent in their individual financial statements. So I'll give you a brief introduction about consolidation. Consolidation means preparing group statements. Okay, you are forming a group. An acquisition happens. In the group, there are 3 members. There will be a parent company who has control. Then there will be a subsidiary company who is being controlled. And finally, you have NCI, the non-controlling interest. NCI, group of shareholders that does not have control. Okay. So these are the members of a group. So in this group, if you need to prepare a consolidated statement, it is very important that the parent has control over subsidiary. So here we need to identify which two of the following are requirements of preparing consolidated statements. Does it require that all subsidiary must adopt the accounting policy of parent itself? Anything like that have you come across? You have already got the answer, C and D. Okay, so we'll just read it. So I have never seen anything like that. So I'm sure that this is not the right answer. Okay, in the textbook, nowhere it is mentioned that the accounting policies of parent and subsidiary must be same. So since there is nothing like that, I can eliminate it. Now we only have three options. Subsidiaries with activities which are substantially different to activities of other members of group should not be consolidated. Is there anything like that? Like if I'm the parent company and I'm in the like manufacturing sector, I'm producing bottles, but my subsidiary, they are into medical sector. Okay, but is there anything like that if I cannot have a subsidiary with another field in another sector? Nowhere. I haven't seen anything like that in your textbook. So this is also eliminated. Okay. Now itself you have eliminated both option 1 and 2. Now the only remaining options are the option 3 and 4. So before reading itself, you can say that option 3 and 4 are correct. So let's read it once at once. Here you have uh, all entities' financial statements within a group should normally be presented on the same accounting year prior to consolidation. Yes, normally that is the case. Normally, your parent and the subsidiary will be presenting the statements for the same accounting year. That is correct. And unrealized profit within the group must be eliminated from consolidated statements. Exactly, that is a correct point. Whenever there is unrealized profit arising in the group, that must be eliminated from the consolidated statement. We will be removing it from the group inventory. Okay, so for the last two options are correct. So here you can give a tick mark. Option C is correct and option D is also correct. Now you can do the remaining questions. You have next option here. Again, I'm not solving everything. This is how your ACCA questions look. See, there are so many theoretical questions also. The previous question was a calculation question. They are requiring some value. So there can be theory questions and calculation questions, almost equal weightage. Okay. And these types of questions can be there. So if you have, if you read this question and you don't know the answer, but your time is running, so you need to come back later. So you can flag it here. Here you have flag option. You can flag it here later. After completing the exam, after writing everything, if you have time, you can come back to read this question carefully. Okay. Now you have a navigator here. In this navigator, if you press this navigator, you can see everything that you have completed. You have completed question 1. These question 2 and 3 you have not answered. Question 4 you have flagged it, so you can come back. Then the remaining are unseen. You have not seen it. If you directly want to go and do question number 31 from section C, if you need to attend section C first, then click the navigator and you can directly go to section C. In section C, there are 2 constructed response questions, 20 marks each, and total marks will be 40. So let's see. Here you have your essay question. Prepare a schedule of adjustments required to retained earnings. That is for 8 marks. Schedule of adjustments to retained earnings means you will be adjusting the retained earnings with whatever profit. So this is somewhat like you need to have the knowledge of SOPL. You need to understand how to prepare SOPL. Why is it required here in case of retained earnings? Yesterday I told you retained earnings means it is a basket containing the accrued profit. Okay, the total accumulated profit for all these years, profit and loss. So whatever is the adjustment happening to the profit, that itself will be the adjustment happening to this retained earnings. The schedule of adjustments required to retained earnings means if you have an income, you read this question, and if you identify that there is an income to be included in SOPL, that income will be added to the given retained earnings figure. If you have an expense to be deducted in SOPL, then that expense will be removed from the retained earnings. So do all these adjustments and finally you'll be getting an adjusting figure. So the benefit is you are not required to know the format of SOPL in such questions. Okay, you just understand what are the expenses, what is the figure of expense to be deducted from SOPL and what is the figure of income. That is the only knowledge required. Okay, so if there is any expenses, that will be deducted from the given retained earnings, and if there is any expense income adjustment, it will be added to the retained earnings. Then the next requirement for 8 marks, for 9 marks, it is preparation of statement of financial position. You are required to prepare SOFP. So There is also a note. The notes, the statement of financial position are not required. You don't have to record any note based on SOFP. You only need to understand. You want to understand question. You can directly go give the heading B. This is B requirement. Give the heading preparation of statement of financial position for the year ended 30 September 2005. In this statement, now itself you can recall, you can draft the format statement. After drafting the format statement, you can go for, after drafting the statement, give workings. Okay, I'll teach you how to frame an interpretation question. Listen carefully. Soon after reading the requirement, copy paste the main heading. Statement of financial position for the year ended 30 September 2005. That is the heading. For 30 September 2005, in your SOFP, you are drafting the format, just as we did before. Asset, you have classification, non-current asset. You are writing all non-current asset. PPE, goodwill. Sorry, goodwill will not be there in individual statement. Investments, intangible. Okay. So these are the things coming under non-current assets. Then you have current assets. Okay. Like that, you can frame the format. After getting the current asset, you will be giving total assets. Okay. Then after total asset, give the next heading, equity and liability. Under equity and liability, you are giving the next subheading, which is equity. Under equity, you have share capital, you have share premium, revaluation surplus, and retained earnings. Okay, after that, you'll give the next heading, non-current liability. Under non-current liability, there can be long-term loan and there can be deferred tax. Then, and long-term provision can also be there. Then give next heading, current liability. Under current liability, there can be payables. Okay, and there can be current tax provision, short-term loans, overdraft, all those things will be there. So after this, give the heading, give the total equity and liability. Okay. So this is how you frame the format. I didn't read the scenario now. You soon after reading the requirement itself, you can draft the format. That is the first step. Okay. Step 1, read the requirement. Step 2, draft the format. And step 3, give workings for each adjustment. Workings. Give working note number 1. Now let's see here for preparation of SOPL and SOFP, you will be always given a trial balance and a few adjustments in your question. So based on the adjustments given, you read the first adjustment and understand which standard this is related to. Okay, a loan note was issued on 1st October and incurred issue cost of 1 million which was charged to SOPL. From this first sentence itself, you understood which standard to connect. What is the topic? What is the heading that you can give to working note 1? Adjustment 1 is related to loan and loan is related to which standard? Loan notes. Anybody? When you are issuing a loan note, it is connected with IFRS 9. Very good, Hitanshu. IFRS 9, that is financial instruments. Or you can be more precise, it is related to financial liability. Okay, you are issuing a loan note means you are borrowing funds. So it is financial liability
and the reference standard is IFRS 9. Even if you don't learn this number, it is okay. But if you can give this number, then it's good. Okay, it becomes more attractive to the examiner. If you don't know this IFRS 9, if it's a 9, 10, whatever, you don't need to study this by heart, this number and all, but you need to give a relevant heading. And now you connected with IFRS 9. So IFRS 9, financial liability, think about the rules. For statements, subsequently, you followed amortized cost model in IFRS 9. So applying amortized cost model, you had an equation, opening plus effective interest minus interest paid, that is closing. So you have all the information given here. See, you have issue cost 1 million. Issue cost is based on initial value. Initial value equal to cash paid minus issue cost. Cash received minus issue cost, isn't it? So whatever is the cash received, from that figure, you will be deducting the issue cost. Then interest payment 1.8 million is given. Effective interest 9% is given. All relevant information is there. So this is how you do the working. Now, after doing first working, you do the correct treatment first. Correct treatment, you have to do it first. It is based on the standard. Based on the standard, here we are following amortized cost model. As per amortized cost model, there are so many rules that you have learned. Now calculate, here we are supposed to prepare SOFP, isn't it? From amortized cost model, from IFRS 9, what is the amount taken to SOFP? You need to consider that. Okay. And also you have first requirement here, that is preparation of schedule of retained earnings. So the schedule of retained earnings means you are adjusting the retained earnings as per the profit. Okay, this is directly connected with SOPL. So here, instead of asking you to prepare SOPL, they are asking you to adjust the retained earnings. Okay, so to adjust the retained earnings means you have to add profit to retained earnings. But the profit is not directly given. So you have to calculate the profit. So that is what is required here. So for that, you need to have the correct amounts to be taken to both SOFP and SOPL. Okay, and SOPL. Sometimes they might have done something wrong. Okay, here I feel this is wrong. Issue cost, they have charged to SOPL. But this is not the correct treatment. For financial liability, you will be treating issue cost as a deduction from your cash received. Okay, but they have, instead of deducting it from cash received, they have included it as an expense to SOPL. Okay, but this needs to be corrected. So that is your next thing. First, we have to give the correct treatment here. Then analyze the wrong entry passed. Already made, and you have to correct it. Okay, so these are the two things that you need to consider when you're doing a working note. Based on one note, you can create one working. So based on this note, you are creating a working note for financial liability. From this, you got the values to be taken to SOPL and SOFP. We have learned it as per IFRS 9. And after that, see if there is any wrong things made by the company. Anything that is done wrong already. So this charge to SOPL, this is a wrong entry that they have passed. So you need to remove it. To remove an expense, you will be adding back this expense. Okay. So this interest 1 million, they have deducted it in the profit. So to adjust it, you will be adding back this profit. Okay, sorry, adding back this expense. That is the correct treatment. So that is how you need to approach this single entity statement preparation question. Now, one by one, you can go. This is regarding non-current assets. The reference can be IAS 16 or it may be IAS 40. If it's investment property, yes. This is investment property. So your reference, your heading will be investment property IAS 40. If it's regarding the non-current assets used for business purpose, then your reference will be IA 16. So read it carefully, give a proper heading, do the correct treatment first, take the values to SOPL and SOFP. Okay. And after that, if there is any correction required, you need to pass the correct entry also. And your C question is prepare extract from cash flow statement. This is what I mentioned yesterday. They will not be asking you to prepare a full-fledged cash flow statement, but they can ask you extracts. See, it's only for 3 marks. Okay, only for 3 marks. Extracts from Candy Company's statement of cash flows for operating and investing activities. You have 3 division in cash flow statement: operating activity, investing activity, and financing activity. So they need you to calculate the net inflow or outflow from operating activity and net inflow or outflow from investing activity. That's it. You don't need to prepare the whole SOCF. Okay. So you have to go through the concepts. Our time is already limited. I don't think we can solve a full-fledged question, but I'm confident that I have taught you the step-by-step approach to solve questions. Okay, if it's a single entity statement preparation, step 1, read requirement. Step 2, draft format. Step 3, workings for each adjustment. And for the last part, from the workings, values are substituted to, no, values are taken to the draft format. Okay, that's it. So these are the 4 steps that you need to follow when you are calculating, when you are preparing your single entity statements. Okay, when you're preparing individual statements, you can follow this approach. Then, now let's go to consolidation. We have a few minutes left. I'll teach you how to solve consolidation. Okay, so this mock exam, you can end the exam, and here in the screen itself, you will have your marks. Okay, let's see the mark. We did the specimen exam now. We are going for self-marking. Yes, this is the question we did, and we got 2 marks. Okay, self-marking. They have given the answer. The correct answer is that all entity financial statement within the group normally prepared to same accounting year and prior to consolidation, and unrealized profit must be eliminated. So this is the answer, and our answer is correct. So we got 2 out of 2. Okay. Then for each questions, you can value like this. Whatever answer you have given here, you can correct it, and the sample answer is here. Okay, this is your sample answer. That is how you value your answers. Next, let's see this last part. Question number 32. This is question number 32. We didn't answer this, isn't it? This is question 31. We did not answer this also. So, if you have answered this, you have the sample answer here. Based on this sample answer, you will be correcting. See here, you can make self-assessment. This is the answer for Candy Company, the company that we have done now. We didn't do an answer and we didn't submit our answer, isn't it? So since we did not submit, our answer is not here. This is the retained earnings adjustments. Okay, the adjusted retained earnings is here. Everything that comes in SOPL as income and expense, the gain, depreciation, income tax, finance cost, all those things are adjusted here. Then this is Candy Company's SOFP. Total asset, total liability, cross-check your answer. This is the extract cash flow statement. See, cash flow from operating activities, you have only 3 adjustments: add back depreciation, Deduct the revaluation gain and deduct the gain from disposal of investment property. You have a format for SOCF. You can learn the format. Okay, what all items are coming in SOCF? If you understand that, that is more than enough for you to score the marks from cash flow statement. Okay, theoretically, you don't have lots of rules to learn. You have to understand the format of SOCF. That's enough. Okay, now in cash flow from investing activity, the investment in the property, or if you are investing in shares, if you are investing in debentures, loan notes, all those investment will be coming here. Okay, so from investment activity, you only have one inflow, that is 17,000. Okay, so that's all about the cash flow statement and statement preparation and how you adjust this retained earnings. Retained earnings adjustment means you are required to do the SOPL profit calculation without a pro forma, without a format. That's it. Okay, so this is how you assess your mock exams. Now, I hope you understood how to access your mock exams and how to practice it. Okay, is it done? Make sure that you do at least 2 mock exams before your main exam. That is my request. Got it? Yes, you are welcome, Zek. Okay. So now I have only consolidation left. Consolidation, I'll teach you how to give the answer again. Okay. If possible, I can share you the recordings, but I don't know how. The recordings are there in the LMS platform of FinChartered. If you want, you can give a request in the hotline number that I had shared yesterday. Okay. Then you'll be getting the recordings of this actual question solving of statement preparation. I have been preparing the statement. I had prepared the statements in my live class. Okay. So that live preparation you can access. No, dear, we don't have a session tomorrow. Tomorrow I'm having a live marathon session for taxation. Okay, I'm handling both financial reporting and taxation. Tomorrow and after tomorrow, I have this marathon session for tax. But now I have a relaxation. I believe that I delivered so many things that is helpful for you for your examination. If you have attended lively all these 2 sessions, that is yesterday's session and today's session, I'm sure that you have everything to pass your exam. Okay, if you have understood what I have discussed in today's and yesterday's class, I'm sure that you will crack your exam in June session itself. Okay, but from your part, you need to do the practice and follow this pattern, follow this revision pattern that I have given you. Okay, your timetable. That's what you can do. Now let's do this consolidation question. Okay, I'm not solving this question. I'm teaching you how to solve this question. So this is a requirement for 20 marks. Prepare consolidated statement of financial position for Dorby Group as at 31st December 2006. So this is your requirement. As soon as you read the requirement, take your answer sheet. Okay. Let's suppose this is your answer key. Here, you will be recording. You'll be preparing the draft format. So step 1, again, read requirements. Read requirements. Then, second one, draft format. For consolidated SOPL or SOFP. Here it is consolidated SOFP. So after drafting format, if it's for consolidated SOFP, you can directly go to workings. Workings, you have working note 1. It is group structure. I'll tell you how to frame this group structure. You have 5 questions. 5 to 6 questions. You only have to answer these questions in your group structure. That is, name of the parent, name of subsidiary, percentage holding of parent company over subsidiary company, percentage holding of non-controlling interest, then the date of acquisition, and if there is an associate company, you need to give the name and the percentage holding of associate company also. So these are the things that you need to consider in the working note 1. In working note 2, you are calculating net assets of subsidiary at date of acquisition and date of reporting. Okay. Then in working note number 3, you are calculating goodwill. Then working note 4 is based on NCI calculation. Working note number 5 is group retained earnings. Okay, sometimes there can be working note 6 where there is an associate company, that is investment in associate. Who is an associate company? A company in which parent has significant influence, which is represented by 20% to 50% shareholding. Okay, so if there is an investment in associate company, then that investment in associate, you have a working note number 6. All these working notes you have to learn, you have to by heart. I will say by heart itself, because whenever there is a preparation question coming, you can save lots of time when you have this format in mind. So you have these 6 workings. After that, you can substitute, you can take the values from the working notes to the draft format. Okay. So this is how you need to prepare your consolidated statement. In this question, your requirement is consolidated SOFP. So you have drafted the format for consolidated SOFP as soon as you read the question. Then under the format itself, you are giving the workings. Okay. Working note 1, group structure. Working note 2, net asset. Then goodwill, NCI, and retained earnings. If there is associate, then you have to follow this working note number 6 also. Otherwise, if there is no associate, these are the 5 standard workings that you need to prepare. After doing the working notes, you will be taking the values from the working notes to the draft format. Okay, now I'll show you a draft format. You can take a screenshot. These draft formats include every adjustment that you have learned. Okay, just give me 1 second. Let me take it. I don't know where it is actually. This working note. Or else I'll teach you now, just a few minutes. See, this is a draft statement. In your consolidated statement, for Dobby for the year ended, this much. Okay. You are giving a proper heading. Consolidated statement of financial position for the year ended 31st December 2006. Then here, this is your amount column. Your amounts will usually be in dollar thousands. So you can give a heading dollar thousands. Okay. If it's not, then let it be like that. Then this is the draft format for SOPL. In PPA, you can have a few adjustments. Add the asset of parent company plus subsidiary company. The individual SOFP will be given in the question. Here, you have three subsidiaries, Dorby company, Kroll and Hens. This Dorby is the parent company because Dorby purchased 80% of shareholding. So, acquirer is the parent company. Dorby is parent. Kroll and Hens are subsidiary companies. So, this values in PPE must be added amongst the subsidiary and parent. Then if there is any fair value adjustment, it will be added. Fair value adjustment minus fair value depreciation. These are the maximum adjustments happening in PPE. Then for goodwill, you have working note number 3. Then for investments, you will be including investments of parent plus subsidiary minus investment in subsidiary and associate. Okay, so you have to see what parent has invested in subsidiary and associate company, and that investment amount will be deducted from the total investments. The remaining investment will be included in the consolidated statement. Then in inventory, you have parent plus subsidiaries inventory minus unrealized profit. Then if there is a cash in transit adjustment, a goods in transit adjustment, you assumed that the goods have been received. So if you assume that you received the good, then your inventory will be increasing. So plus goods in transit. This is the adjustment to inventory. Then receivables. Parents receivable plus subsidiaries. Then if there is a cash in transit, you assume that the cash has been received. So the amount of cash received will be deducted. Cash in transit. And the value of intra-group transaction, that will also be removed from both receivable and payable. So intra-group trade value. These are the adjustments in group receivables. In cash, you will be adding the cash balance of parent plus subsidiary. Then from cash, you are expecting the cash in transit. You are assuming that the cash in transit have been received. That is the treatment of cash in transit. So when you receive cash, you are increasing your cash balance. So add cash in transit. Even if it's actually not transited, even if it's not received by the receiver, you are assuming that it is received. Then you will be adding them together to get total assets. Then your heading is equity and liability. In equity, you will not be adding parent and subsidiaries equity. You will be only including parent's equity plus if there is any unrealized share exchange happening. Okay, that is very rare. Only if there is a purchase consideration of share exchange, then a value will be here. Otherwise, you don't need to be confused. Just keep in mind that the parent's value in your statement, Dorby is the parent. So parent's share capital 500,000 will be included here. Directly just copy this 500,000 and just paste it here. Okay. Then group retained earnings, you have working note 5. Non-controlling interest, you have working note 4. You have to learn the formats for these workings. Then for long-term borrowings, you have parents liability, parents loan plus subsidiaries loan. Then what else can be there in the liability? That's it. Just add parents and subsidiaries liability. Like that, deferred consideration. The purchase consideration given by parent to subsidiary can be of 4 types. Cash consideration, share exchange, deferred consideration, and contingent consideration. So if there is a deferred or contingent consideration, these are payments to be received in future date. So in this situation, you will be calculating the present value. So this present value of consideration plus unwinding. Okay, plus unwinding cost. That is the amount to be included in non-current liabilities. Then, current liabilities, you have trade payable, add the payables of parent plus subsidiary minus any intra-group transaction. And if there is goods in transit, then you will be adding payables. Goods in transit. Okay. So these are the maximum adjustments that can be coming in your consolidated statement. Okay. So whatever is the adjustment in your question, you read the question carefully and you will be putting the values, corresponding values to PPE, goodwill, investments, everything. Okay. Finally, you will be balancing your total assets with total liability and equity. This is how you prepare consolidated SOFP. Okay. Now, these same steps will be applicable for SOPL also, but you don't have standard workings. Okay. You have workings, but this standard workings are not available. Step 1, read requirement. Step 2, draft format of consolidated SOPL. Step 3, do workings. Step 4, take the values from the workings to the main format. Now, I'll draft a format for consolidated SOPL also. If you were asked to calculate the consolidated SOPL, I hope you took a screenshot from this. Is it done? You have to learn this format and what all adjustments are coming in asset and liabilities. Yeah. Yes. Okay. Now I'll give you the format for consolidated SOPL also. What are the maximum adjustments coming in SOPL? Just give me a minute. Yes, you need the treatment of unrealized profit. Of course, I can do it. Here, unrealized profit is where I'll teach it from this question itself. There will be an adjustment for unrealized profit in all consolidation question. Where is it? Yes, here. During November 2006, Kroll Company sold goods to Dorby Company. Okay, listen carefully. I'll explain with this question itself. During the November 2006, Kroll Company sold goods to Dorby Company for 18,000 at a markup cost of 20%. Half of these goods were still held by Dorby Company at 31st December 2006 and the balance payable was still outstanding. Okay, so this is a payment from Dorby, from Kroll to Dorby. Okay, from Kroll to Dorby. Okay, we know Dorby is the parent, Dorby is the acquirer. So this is a transaction from parent to subsidiary. Sorry, subsidiary to parent. Kroll is subsidiary, Dorby is parent. So this is a situation of transfer from subsidiary to parent. If you are transferring goods from subsidiary to parent, in that case, the unrealized profit arising will be taken to working note number 2. Working note number 5. Sorry, 2 itself. If subsidiary is the seller, unrealized profit is taken to working note 2, net asset of subsidiary. You will be deducting it from date of reporting. Okay, in working note 2, you will have 2 column headings, date of acquisition and date of reporting. If subsidiary is selling to parent, Then unrealized profit is taken to working note 2 and it is deducted from the date of reporting. Now let's see how to calculate this unrealized profit. Unrealized profit equal to profit on the inventory sold between group that is still remaining in the warehouse. Okay, so whatever is the intra-group transaction, see the value, total value of intra-group transaction. Out of this, whatever is remaining in the group, in the warehouse of the group itself, then that remaining inventory's profit is known as unrealized profit. For example, Kroll sold to Dorby for 18,000. 18,000 worth goods is sold from Dorby to from Kroll to Dorby. Out of this 18,000, if 10,000 has been sold by Dorby to the customer, to the final customers, to the third party, then in that case, the remaining inventory will only be 8,000. Upon this 8,000, what is the profit? That profit amount is called unrealized profit. They will be giving you a clue to calculate URP, either margin or markup. Okay. So if it's margin, then margin percentage. If it's margin 20%, it represents the percentage of profit on selling price. Okay, selling price. And if it's markup, then it is percentage of profit on cost. Okay, whatever is the cost, the percentage of profit on cost is markup. Here in this question, they have given you markup percentage. And this is 18,000. This is the total sales value, selling price. Okay, so here you have a basic equation. You have to apply the basic equation. Selling price is equal to cost plus profit. You don't know what the cost is, but you know what is the total selling price. The total sales price is, total sales value is 18,000. So 18,000 is equal to cost plus profit. You don't know the figure of cost, you don't know the figure of profit, but you don't know the percentage of profit. Here it's given that profit percentage markup is 20. Okay, if it's margin, then you can apply this 18% of, 18,000's 20%. Okay, 20% of 18,000 itself will be the value of profit. But if it's markup, then you have to calculate cost and 20% of cost will be profit. So whatever is 20% of cost, that is profit. So using algebra, you can solve this. 1.2, we can say 1.2 of cost is equal to 18,000. So cost will be equal to 18,000 divided by 1.2. How did I get 1.2? 1C plus 0.2C. Your answer will be 18,000 divided by 1.2. That is 15,000. So 15,000 is your cost. So what will be profit? Profit will be 20% of cost. Okay. This into 20%. 3,000 is the profit and 3,000 is the profit that must be deducted from working note number 2. Okay, this is a case where subsidiary is the seller. Where subsidiary is the seller, unrealized profit will be calculated based on the given markup or margin. Thus, unrealized profit figure is deducted from the date of reporting in working note 2. Now, when you are calculating the unrealized profit in the same manner, but when parent sells to subsidiary, in that case, this unrealized profit will be taken to working note 2. Sorry, working note number 5. When parent is the seller, Then this unrealized profit is deducted from working note 5. Deducted from working note number 5, group retained earnings. That is the case where parent is the seller. Got it? And in both cases, if whether parent or subsidiary is the seller, regardless of this case, the amount of unrealized profit is removed from consolidated SOFP, from group inventory. DOR is date of reporting. You have two column headings, date of acquisition and date of reporting. Okay, net asset of subsidiary. Yes. Anything else? So I'll show you the basic format for preparing consolidated SOPL, and then we will wind up today's session. Yes, you are welcome. Okay. So you draft a format for consolidated SOPL, follow the same procedures. In consolidated SOPL, you will be including 100% income and 100% expense of parent and subsidiary. Okay, you are combining 100% income of parent and subsidiary. You are combining 100% expense of parent and subsidiary, but do time apportionment. Okay, from the here you have the you have to note post acquisition period. In the post acquisition period, whatever is the number of months, for that number of months, you will be apportioning subsidiary companies' income and expense. Okay, based on post acquisition period, parent companies' full year's profit and income and expense will be considered, and subsidiary companies' income and expense will be time apportioned for the post acquisition period for the number of months. So here for revenue, you have parents' revenue plus subsidiaries' revenue minus intra-group transaction value. Okay, that is revenue. Then, just give me 1 second. Let me drink some water. Okay. So intra-group, if any intra-group transaction is there, that will also be affecting the revenue. Then you have cost of sales. Cost of sales has the majority adjustment, that is parents' cost of sales plus subsidiaries' cost of sales minus the intragroup transaction value. Okay, you are removing the intragroup transaction, the same value, the 10,000 from both revenue and cost of sales. Okay, then if there is any fair value depreciation, you will be adding it here. Fair value depreciation will be added. Then if you have unrealized profit, that will also be added here. If parent is the seller or if subsidiary is the seller, you'll be adding the value to cost of sales. Okay, so these are the adjustments happening in cost of sales. Parents plus subsidiaries minus intra-group transaction plus fair value depreciation plus unrealized profit. Then in operating expenses, you will be adding the distribution and administrative expense of parent plus subsidiary. Then you will be adding any impairment loss. Okay, if there is any impairment on goodwill, that is also added here. Then in finance cost, you have parents interest expense plus subsidiaries interest expense minus intra-group loan interest. Intra-group loan interest. Okay, if there is a loan provided by parent to subsidiary or by subsidiary to parent, in that case, the interest on this loan will be removed from finance cost. Then you have investment income. You will be adding investment income here. On this investment income, you will be adding parents' income plus subsidiaries' income minus intra-group loan interest. Again, because for one person, this will be interest receivable, and for the other person, this will be interest payable. Okay, so this interest income and expense will be removed from the statement. So intra-group loan interest is removed from finance cost and investment income. Then if there is a dividend received by the parent from subsidiary or associate, that is also removed. Dividend from subsidiary or associate, that is also removed. Then you get profit before tax. From PBT, you will be deducting income tax. It's just a simple adjustment. Nothing much to learn in financial reporting. After that, you will be getting profit after tax or profit for the year. Okay, 1 second. So this profit for the year or profit after tax, you will be distributing it or you'll be allocating it between the parents and non-controlling interest. Okay, so here whenever there is a disposal, this is regarding group disposal. Okay, a specific case. It's not a working note 6, just remove it. You will have a working note based on group disposal. Okay, whenever you are disposing a subsidiary, for example, here during this year, if Dorby is disposing Kroll, then you have to record a separate value, profit from discontinued operation from Kroll. You have two different treatments for discontinued so for group disposal. First one is just do like this as a single line item, as we have learned yesterday in IFRS 5, profit from discontinued operation, which includes the profit after tax for till the date of disposal and the profit or loss on disposal. The total figure will be included here whenever a subsidiary is disposed. Otherwise, you have to incorporate the values or the till the date of disposal. The income and expense of subsidiary till the date of disposal will be included here. Okay, if you want, you can follow that method. Otherwise, you can do you can remove completely. You don't add all income and expense of Kroll Limited, the disposed company, whatever is the disposed subsidiary, you will not be including the income and expense in the statement. Instead, as a single line item, you can include the profit or loss. Okay, that is enough. This is the easiest method. I prefer this method. Okay, either method can be followed for group disposal, but this showing in a single line item is the easiest method. You have the profit figure here. So apportion the profit till the date of disposal. Okay, this is not profit, sorry. If you are asked to prepare SOPL, then they will be giving you the profit figure. So that profit figure will be time apportioned. And it will be given here, profit from discontinued operation. Okay. Then this profit, what you got here, that will be divided as profit attributable to owners of parent and profit attributable to NCI. It need not always be working note 7. It can be any working note. You have a working note to learn based on NCI's share of profit. Share of profit. You have a working note for this. You have to learn this from your textbook. So applying the working note, you will be getting the value here. You know what is the profit for the year, total profit for the year. The balancing figure, the difference between these two will be the profit attributable to parents. balancing figure. Okay. So this is how you finally present your consolidated SOPL. You have concepts to learn from your textbook, but once you learn the concept, this format will help you a lot. What are the maximum adjustments and where all the adjustments are coming? Only a few adjustments are there in SOPL. Fair value depreciation, unrealized profit, impairment, intragroup interest, intragroup dividend, and this calculation of profit of NCI. These are the things coming in consolidated SOPL. Okay. So you can take a screenshot of consolidated SOPL also. Is it done? Yes, great. So you have to keep these two formats in your mind. The adjustments you have to keep in your mind, remember. But make like what? Make one thing clear that consolidated statements formats, the format that I told you that you have to by heart, working notes, those formats should be there in your mind. Okay, it can save lots of time and it can help you to get high marks, get very good marks in consolidation. Compared to single entity, consolidation is easier. Okay, you'll understand it when you start practicing your essay questions. Okay, compared to single entity statement preparation, consolidated statement preparation is easy. So the two formats, yeah, these are the two formats that you need to keep in mind. Other formats that I am discussing about this working note formats, working note 1, working note 2, net asset of subsidiary, working note 3, calculation of goodwill, working note 4, net asset of, non-controlling interest, then, and working note 5, retained earnings. All these things, you have working notes. I can share the working notes if you want. You can take a screenshot, just 1 minute. That working notes, it must be by heart. Then only this format will be of a help. See here, this is working note number 2. Working note 1 is nothing, but you have to answer the name of parent, name of subsidiary, group retained earning, then the date of disposal, all those things. Date of acquisition. Okay, and if there is associate, the name of associate, percentage of NCI, percentage of parent. These are the identification part. Read the question and identify these values from the textbook. From the question. That is working note 1. Working note 2 is net asset of subsidiary. You have to understand this working note. These are the maximum adjustments happening in working note 2. Maybe only 3 of them are there, maybe only 4 are there, maybe 2 are there. Okay, so these are the maximum adjustments happening in working note 2. Take a screenshot of working note 2. Study this format. See here, unrealized profit, if subsidiary is the seller, it is deducted from the date of reporting. This is DOR. And you have date of acquisition, DOA. Okay. So you can take screenshots. Then this is working note 3, goodwill calculation. The format is purchase consideration plus, yes, this is for SOFP. For consolidated SOFP, you have 5 standard working notes. Okay, these are the working notes that you need to learn. And whenever you're required to prepare consolidated SOFP, you can give these working notes as it is. Working note number 3 is goodwill calculation. Okay, take a screenshot of this also. Let me know if it's done. Can we move to the next working note? Yes. This is regarding calculation of NCI, working note 4, non-controlling interest. It's a simple working note. NCI's value at acquisition as per working note 3. In working note 3 also the same figure will be there. Plus post-acquisition reserves. You know what is post-acquisition reserves? It's just a revision. I hope you already know. Post-acquisition reserves is the difference between these two figures. Okay. The difference between these two figures, that is PAR, post-acquisition reserves. This post-acquisition reserves will be split between parent and non-controlling interest. No, for working note 1, there will not be any specific marks. Okay, you cannot expect any marks for working note 1, but it's like it will help you to do the further calculations. Even if you don't do working note 1 also, no issue. Okay, Shubham? Yes. Okay. But working note 2, 3, 4, 5, these are all calculations and these workings gains mark. So from working note number 2, you get the difference as post-acquisition reserves, and this post-acquisition reserves is split between parent and NCI. Okay, if parent's holding is 80%, then PARE into 80% for parents. Then PAR, post-acquisition reserves, into remaining 20% is for NCI. It will be allocated like this. Okay. And this share of NCI, it will be included in working note 4. Here in working note 4, you have share of profit, share of post-acquisition reserves minus NCI share of impairment of goodwill if fair value method is followed. You have two methods for NCI, that is fair value method and proportionate method. All these things you have to learn. This is just a revision. If you are following fair value method to calculate NCI, then value of NCI is equal to fair value of the shares of NCI into the number of shares. The number of shares into value of share price of subsidiary. That is the equation for calculating NCI's value as per fair value method. If the company is following proportionate method, then you will be getting NCI's value by applying this equation. NCI's percentage into fair value of net assets at acquisition. From working note 2, you have net asset at acquisition and net asset at reporting, isn't it? From that net asset at acquisition column, the total is multiplied with NCI's percentage. So you will be getting the value of NCI, and this is known as partial goodwill method. Partial goodwill method. Then this fair value method is also called full goodwill method. Okay. Got it? You can take a screenshot of this also. This is based on NCI, working note 4. You need to learn this format. Then this is working note number 5, group retained earnings. Got it? You took a screenshot. I hope it's done. Parents 100% retained earnings plus post-acquisition retained earnings. From working note 2, you will get the post-acquisition retained earnings or post-acquisition reserves. Then share of associate also. Parent share of associate retained earnings is also included. Impairment is deducted and unrealized profit where parent sells to subsidiary is also deducted in working note 5. And in case of associate, if parent is a seller or if associate is a seller, the arising unrealized profit will be deducted from here. And keep in mind one point here, multiply the associates unrealized profit with parent's percentage. Okay. In case of unrealized profit of subsidiary, you're not multiplying it with the acquisition percentage. If the parent's holding is 80%, you're not multiplying it with 80%. But in case of associate company, you will be multiplying this unrealized profit with the parent's holding percentage. And that figure will be deducted from working note number 5. I hope it's done. Now, this is the format for calculating NCI. This does not have a number. This is non-controlling interest, share in SOPL. We discussed the format of SOPL. So, in that format, the non-controlling interest share will be calculated like this. Took a screenshot. Only 3 adjustments are there. Subsidiary companies profit from individual statements, from individual FS, minus fair value depreciation, minus unrealized profit if subsidiary is the seller, minus impairment loss if fair value method is used for calculating NCI. Fair value method is used for NCI. In that case, impairments is also allocated to non-controlling interest. Then you will get adjusted profit. This adjusted profit multiplied by NCI's percentage, you will get share of profit of NCI. Okay. So that's it about consolidation. You need to learn these formats and the 2 formats that I gave you in the Excel. Okay. Anything else that you need to ask me? It's already 45 minutes past. Anything else? Anybody? So if there is nothing else, I'm praying for you all the best for your exams. I hope that this 2 days marathon session was helpful for you. Okay, can you give me a feedback? Anything else do you want to know? Was this helpful for you? This 2-day session? Yes. Okay. It was helpful. Great. So all the best for all of you. And this recordings will be provided in the YouTube. You can go through the recordings also. Yes. Thank you. Thank you so much. Okay. So if you need something else, you can contact me personally. I'll share you the like what materials and whatever you want, whatever support you need. All my prayers and support is with you. May God bless you. Okay. Thank you. Bye bye. Recordings, it will be uploaded in the YouTube, and maybe in this group where you are getting the link, they will be sharing you this like what? This link. Okay, link of this recorded video. They'll be sharing you in the group. Okay. This is my number. You can contact me if you have, if you need the recordings. Yes, you're welcome. You're welcome. And thank you for your response. You are all interactive. I know that this is hard time for you. We have spent almost 5 hours. Okay. I can see your dedication for financial reporting, and I'm sure that you guys will make it. And please let me know your result once you crack your exam. Okay. Make me happy. Yes. Thank you. Thank you so much. Yes. So all the best for you. Bye bye. See you. Take care.